Good morning all. I'm delighted to welcome you for our AXA annual investor seminar here in Paris. The format of this year will be a bit lighter, a bit shorter than last year, but I hope you'll find the day as exciting as it has been to prepare it. Henri de Castres, Chairman and CEO of AXA, will shortly introduce the day, followed then by a presentation from Denis Duverne, Deputy CEO. A lunch buffet will then be served next door before we resume for 2 workshops in the afternoon led by members of AXA's management team, and then Henri will conclude. Q&As will be organized during the workshops and at the end of the day, which is supposed to finish at 4 p.m. I wish you a very good day, and Henri, the floor is now yours.
Thank you, Mathieu. It's a pleasure to be with you today. As Mathieu said, it has been a pleasure to prepare for this meeting because we know you have a lot of questions. We've also made sure that you would have some excitement, so we have moved in Australia to be sure that the day would be interesting. But more importantly than that, we want to use the day to try to answer some of the questions which have been around for a few months on the group and on its future. So I'll make a brief introduction, and as Mathieu said, Denis will follow before we go to the breakout sessions. I think the first point I want to highlight is that during the crisis, I think the strengths of the group has been further recognized, not in the share price, but certainly in its operating model. If you look at what is important in the very long run, do you have the trust of your clients? Do you have the trust of your employees? Is your capital a strong one? And is your brand recognized? I think we are matching all the boxes. Interestingly, the trust of the clients has been growing during the crisis. The engagement of the employees has been growing and then staying stable. And we think we can bring it higher. We have become the first insurance brand worldwide. You could see that as being a sort of soft material. We don't think it is, because what we see is that, especially in the emerging world, but also beyond that, when big institutions are looking for partners, they are going to the ones who have the recognized brands. I do not think we would have done the ICBC deal as an example if we had not been a very strongly recognized brand. And this is a result of the work we've done over the last years. Last but not least, I think it's important to remind you that we have, I would say, stood on our own during the world crisis. We didn't ask for anything from anybody. Having said that, the world after is going to be different from the world before, and we recognize that. There are short-term challenges for the industry and for us. We have to face them. On the other hand, the long-term potential of the industry is still intact. The pension gap is still there. The fact that you have more and more affluent people, rich people in the world is creating opportunities for us beyond this short-term environment where a number of challenges have to be addressed. If we think that the world after is going to be different from the world before, there are 3 areas where we need to address specific questions: capital, efficiency, and growth model. And this is what we will try to do today. On capital, just to set the scene, we are strong. We have a diversified capital allocation and a strong balance sheet. If you look at our internal model, which is, as you know, very close to what Solvency II is going to require, we need an economic capital of 28 billion. If you look at where are the needs, both by geography and by businesses, you will see that it's diversified, which is a factor of risk reduction. If you look at it by geography, the two places where we need approximately a little more than 20% are the US and France. A little less than 20% North Sea, and the rest of it is spread between the various regions. If you look at the needs by business lines, and there for the first time we have splitted the life business in three pieces: unit-linked, general account investment and savings, and general account protection and health, because we think these businesses have different prospects, different margins, different risks. What you will see is that if 60% of the economic capital is affected to the life business, it's approximately 3 equivalent blocks. 20%, a little more than 20% to protection and health, a little more than 20%, a little less, sorry, than 20% to the general accounts, and approximately 20% to unit linked. And then you have the P&C businesses and the rest of the group. P&C is a little less than 30%. So diversified geographically, diversified by business line, and this under the umbrella of a very strong coverage at 167%. This capital is not only well diversified, it's also a capital where we have been showing a significant agility over the recent years, which I think in the current environment is particularly important. As you know, we've been always quite active on acquisitions and disposals. The list of acquisitions, you know it. I think we will very soon add the Asian assets, or the minority share of the Asian assets of APH, to the list of acquisitions. Disposals, we've been pretty active too. And if we look at what we will have completed or initiated and largely completed this year, with the transaction in the UK and with the transaction in Australia, even if the vote there is going to be early next year, you will see that we are active. We have added the partnership dimension because I think it's going to be an important feature of the new world. If you want to capture growth quickly in areas where insurance has not been a given in the past, one of the ways to do it is to partner with local players. And there, I really think that the list of the things we've done in the recent years is quite impressive, especially on the bancassurance side. If you look at what we've been achieving over the last month, look at ICBC, look at the way our partnerships are evolving in Southeast Asia, with Mandiri, with Krungthai, with Metrobank, we start to have a quite significant track record, and I think this bodes well for the future growth. So what this says is we are strong from a financial standpoint. The capital is allocated in a diversified manner, and we intend to manage it quite actively. Efficiency. This is going to be very important because productivity gains are, the way to stay competitive in our various markets. And there I think we are starting to reach the next step. We have set up, as you know, 2 global business lines last year, and today, in the conference this afternoon, you will have workshops related to these business lines. They are helping us setting new targets, not only managing more convergence, but also setting new and more ambitious targets in terms of efficiency for the group as a whole. They help us define a common strategy and monitor better the business KPIs. They help us accelerate the business reactivity. They help us build common platforms, and they help us leverage the levels of expertise we have. And you will see that very, very clearly. I do not think we would have been in a position to share with you what we are going to share today if we had not set up these business lines. In terms of growth, which is the third area I wanted to address in this opening, it's clear that when you look at the revenue numbers, you can have, if you take a superficial look, the feeling that, well, not a lot is moving. because revenues for the first half or for the first 9 months have been, in total, quite stable. What I've said to some of you in the recent one-on-ones we had is this is very similar to the duck on the pond. At the surface, you have the feeling nothing is moving. If you look beyond the surface, a lot of things are going on. In fact, we are not less aggressive than before in terms of growth. We are more selective. There are places, I mean, in this world where it's not worth to write as much business as before, and there are places where you want to accelerate. And given the environment, what we have managed to do is to be more restrictive in some areas, especially in developed countries, because we didn't think the pricing was appropriate, or because we wanted to reprice some products, or because we had the feeling that the capital intensity was too high when compared to other alternatives. And there are places where we can be more aggressive because we want to gain ground. And here, this is something we had been showing with the half-year numbers, but I think it's good to remind it. If you look at the life and savings business, revenues have been going down this year in the US and in France, but they are strongly up in all the emerging countries. Why so? Because we are not chasing volumes in developed countries, and because we want to become more aggressive in the places where you can have high margins, high new business value. It's very much the same story on the P&C side. There are business lines or geographies where you don't want to be as aggressive as in the past because it's not worth doing it. And there are places where you want to be more aggressive because the cycle is better, because the margins are better, because the prospects are better. It is what we are doing. We want to grow, we will grow, but not at any price, because one of the ways to become more competitive than others is to deploy and to use your capital better. And you have to do that in a pretty selective way. So the movements you are seeing on revenues are another illustration of the agility of the group. The fact that the total leads to revenues which are pretty flat doesn't mean that there is a lack of agility or a lack of aggressiveness. I think it's an additional dose of realism. We do not want to grow at any price. We certainly want to grow in the places where you have margins. So I think the model is a very simple one going forward. Short term, there are some issues which have to be addressed. I mean, you know them. We will come back to them. Long term, the potential is intact. The way we are going to create value is simple. It's around this circle: capital, efficiency, growth. In a nutshell, what does this mean from a practical standpoint if we want to have a superior value creation? We need to redeploy capital in a sort of more agile way than in the past. We will give you some examples. We want to improve, and we will improve, the profitability of both our property casualty and life and savings operations. And you will see that setting up the global business lines has helped us to become more ambitious there. We want to run our operations more efficiently. There too, you will see what we intend to do in terms of productivity gains. We want to improve the free cash flow generation. We know this is a question which has been around for a while. We are going to answer that today. We want to increase our exposure to high growth markets, and you see that we are on our way doing that, and this is going to become a significant part of the group. Growth not at any price, I've already mentioned that. And of course, I mean, we want to realize productivity gains, but we do not want to cut the investments which are needed for the future. So we want to continue to invest and innovate. And in this area, we are not going to, I would say, cut the projects. So what we are doing, in fact, is redefining the company project and the long-term targets. And today is a first opportunity to share with you what these plans are. So we will highlight our initiatives, what we do to achieve these key aspirations. We will give you greater visibility on the capital management, on the free cash flow generation, on the life and savings earnings by products, on our US VA in-force book, because we know that you still have questions there, and on the property casualty operations. This is the program of the day, and we will start by Denis' presentation on growth, efficiency, and capital management.
Thank you, Henri. Good morning, everyone. So I'd like to start with a discussion on the dilemma between growth and profitability and how we've addressed it in the last recent years. First, on the life and savings, you will notice on this slide that in the favorable years up until 2007, where we had a new business margin in the 20s, we had a growth in our new business, which was quite high and higher than the market average. In 2008, 9, and 2010, we have chosen to focus on profitability at the expense of growth. And you see, and this has disappointed a number of you, but we believe that to prepare an accelerated profitable growth in the medium term, that was the sacrifice that we had to make. We took a number of management actions, particularly in the US and in France. In the US, we redesigned our VAs. We launched new innovative products like Retirement Cornerstone. In France, we decided not to compete in the very price-sensitive family office business. And going forward, we intend to accelerate our diversification in protection and health, increase the focus on unit-linked with and without guarantees, and prioritize our investments to focus them on the growth areas. This has resulted in 2009 and 10 into an increased new business margin, thanks to an improved business mix. This will probably be partly offset by the decline in interest rates, but we have managed to, I would say, hold our own in terms of new business profitability. We are also focusing on the in-force profitability, which feeds earnings and dividends. We have been able to maintain a healthy investment margin in the last 3 years, and we believe that we are going to be able to maintain it even if we remain in a prolonged period of low interest rates, particularly in Europe. We are managing our duration and convexity gap within prescribed limits. We are adjusting our crediting rates as much as necessary, and we are focusing on optimizing our risk return profile on the investment portfolio. Same story on the P&C side, where during the period between 2004 and 2007, 2008 even, we had quite a good current year combined ratio. So the current year combined ratio, as you know, is the ratio that doesn't include the boni on prior years. We had a current year combined ratio which was below 100 until 2006, just above 100 in 2007 and 8. And during that period, we had an all-year combined ratio which was quite significantly below 100%. During that period, we thought we could afford to have significant revenue growth because we were growing profitably our portfolio. Since 2009, where our current year combined ratio has been well above 100%, we have pared down growth. We continue to have some growth on personal lines, but we focus on profitability, and this has resulted in almost no growth. Again, here we are preparing to accelerate profitable growth in the medium term. I just want to point out briefly here that we have restated our current year combined ratios since 2004 to harmonize them across the group because in Germany and Belgium we were not accounting for them the same way. So we have given you in the slide 7 of the appendix the series of current year combined ratios for during that period. It doesn't change the all year combined ratio, obviously, but we thought we needed to move to a fully harmonized basis across the group, and those are the restated numbers that we are going to, and the presentation that we are going to use going forward. What did we do in P&C to focus on restoring the profitability? We were the first movers on price increases in a number of markets in 2009. We have delivered 2.8% average price increase for the first 9 months. We have pruned some unprofitable portfolios, especially in commercial lines, and we had a stable expense ratio over 2009 and the first half of 2010. Going forward, and François Pierson will talk about that this afternoon, we will continue to segment price increases, but apply on average a 3% price increase on the portfolio in 2011. And probably more importantly, we have decided to target a 4 points reduction on our expense ratio by 2015, which represents a productivity improvement of more than 1 billion euros. We target a current year combined ratio of 100% in 2011, and going forward, we target a current year combined ratio of between 96 and 100% over the cycle. Our previous guidance was 96 to 100% all year combined ratio. We moved to a guidance at the same level for the current year combined, knowing that we will continue to have bonies at different levels depending on the phase in the cycle, but we do not give any guidance, obviously, on the bonies because they happen when they happen. We believe that we will be able to accelerate profitable growth in the medium term. On P&C, we are building a global direct motor platform, which is already present in close to 10 countries. And we have a growth of more than 10% in our revenues for this direct platform. We believe that more and more clients are moving to direct, perhaps not to the same in the same proportion as they do in countries like the UK, but certainly we see a growing trend in direct motor, and we are going to benefit from that. We are expanding in bancassurance. We are very pleased with the successes that we've had with MPS in Italy. We are very pleased with the success we've had in Southeast Asia with the top banks in each of the countries of Southeast Asia. We believe that, we show here the example of Mandiri in Indonesia, which is very successful. And we are also very pleased with the announcement that we've made, which is still subject to regulatory approval, of a JV with ICBC in China. We are going to continue to rely heavily on our proprietary networks. They represent roughly 50% of our revenues. We are going to continue to leverage them, continue to focus on improving the quality of service we give them, continue to focus to expand the technology that we put at their disposal, moving to multi-access, allowing our customers to both be served by our proprietary distribution and to do a number of activities directly over the internet, and continuing to focus on the productivity and sales force effectiveness of our sales force. And finally, we are going to accelerate our growth in emerging markets. The proportion of NBV coming from high growth markets was 18% in the first half of 2010, and this does not include the transaction that we expect to do with the buyout of our Asian minorities. And in P&C, we are now at 12% of our revenues coming from emerging markets, and you see that the pace of growth is quite substantial there. A few words on the AXA IPH proposed transaction. We believe that, as I already said, that it will accelerate our growth in emerging markets. The growth of AXA IPH in Asia is quite rapid. The Asian businesses are also positive contributors to our IFRS earnings and positive contributors to our our new business value. There was a 37% increase in APE and 28% increase in NBV of the Asian assets of AXA IPH in the first 9 months. So you see that it's a very high growth business. You've seen the characteristics of this transaction. Based on the AMP share price of 532 Australian dollars, we are going to invest 1.8 billion euros, representing for 54% of our interest we're going to invest 1.8 billion euros, which is the balance between the Australian assets that we sell and the Asian assets that we buy. We believe that it's a good transaction for all parties. It's a good transaction for AXA IPH because at 643 we are offering the same price that AXA IPH was expecting from NAB until September of this year. We are protecting the minority shareholders against the decline of the AMP share price down to $450, and we would be getting a portion of the upside if the price of AXA IPH increases above the current share price. The minority shareholders would get a portion of the upside, but we would get another portion of this upside as well. In terms of financial impacts, this is marginal on our Solvency I ratio. It increases our gearing by notionally 4 points. Our gearing was 27% at the end of June, and it should be accretive in terms of earnings by 2011. Our cash out is capped at 3.2 billion, and we will be repaid of 700 million of internal loan granted to AXA IPH. So we believe it's a good transaction. We are paying 400 million more than what we had offered to pay in November of last year. In the meantime, clearly the embedded value of what we are buying has increased. We have bought protection against an appreciation of the Australian dollar, so we are getting I would say a gain on this hedge that we've put in place last year. So we believe that the price that we pay is I would say commensurate to the increase in value that has occurred in the business in the meantime. Moving now to capital management strategy, I think we have to balance value creation in our business with free cash flow generation. So we are clearly focused on deploying capital in the geographies and business lines which have the best growth profile and are likely to deliver the best value to our shareholders over the long term. But we also have a commitment to our shareholders to provide a steady stream of dividends. And we believe that because we have a significant portion of our business which is in mature countries, we are going to be able to reconcile the two objectives. This will be possible thanks to good capital agility, allowing us to absorb market shocks, to move capital within the group as we have, I think, been doing quite effectively in the past, and seize external growth opportunities. On this next slide, which is slide 14, just a historical perspective on our return on equity. In the good years, we had a return on equity which was in the high teens. Since 2008, our return on equity is in the low teens. We have showed some resilience in turbulent times because we are still making a return on equity above 11%. but we believe that we need to strive to go back to a much higher level of return on equity, and the strategy that we are presenting today should help us achieve that. Looking at it a different way, which is the operating return on group embedded value, we have had a constant, really high operating return on EV. Obviously, our total return in 2008 was very negative because of the financial crisis, but our operating return has remained good during that whole period. How are we going to optimize value creation? We have three main levers: maximize absolute value, optimize capital requirements, and manage volatility. The main internal tool that we are using for this is our return on economic capital. Henri has showed you what our economic capital requirement was, and also the coverage ratio. This is the internal tool that we use to allocate capital and determine, determine value creation in our various businesses. So, this focusing on the return on economic capital, we focus on the increase in this available capital year on year, and we have a denominator which is the risk capital. So basically, the game is to increase the numerator and reduce the denominator, and that's what we are trying to achieve through an optimized asset allocation, risk optimization with our reinsurance program and our asset liability management, and a proper allocation of capital between the different business lines and countries, a regular review of our portfolio, which from time to time leads to a radical decision like the one we took in the UK, and external transaction assessment, which is M&A, securitization of portfolios, and things like that. So when we look at the life and savings side, we have had an operating return of 16% in 2009, and investment experience which was positive, yielding to a total return of 34%. When you look at this operating return across the geographies, you see that we had a very strong operating return in Asia Pacific, in Japan, and in the Northern European region. But return that was certainly not meeting our expectations in the US, in France, and in the Mediterranean and Latin American region. The reason for the good returns is usually either a favorable expense position or a favorable mix of business with a high content of protection and health or high content of unit-linked. This gives you the action plan that we are putting in place across the board. We need to accelerate our diversification into protection and health. We need to increase our share of unit-linked. We need to prioritize our investments on the geographies and product lines that give us the best return, and increase our business efficiency. Clearly, expense management is going to be a significant part of this game. On the P&C side, when you look at the return, it's 12%, of which 7% operating return and 5% investment experience. This is clearly not satisfactory in terms of operating return because we are currently operating at a current year combined ratio in excess of 100%. We believe that this is understandable because we are currently at what we believe is the bottom of the cycle, or we were in 2009 at the bottom of the cycle. If you look prospectively, if on the right side of the slide, if we were to target 100% current year combined, we would have a 16% operating return on our economic capital. Targeting a 96% current year combined, we would be getting a 24% operating return on economic capital. So we need to focus on the two elements of this combined ratio. the current year loss ratio, and productivity. And by targeting a 96% current year combined ratio, we mean that we are targeting effectively 16 to 24% operating return on our economic capital. Over 2004-2009, our operating return averaged 16%. Henri showed you already the chart on the left side of this slide, which shows the split of our economic capital by business line. On the right side, you have something that we had showed last year at our investor conference, which is the split of our economic capital by type of risk. And you see that the dominant element remains market risk, which represents 50%. If you add counterparty risk, it's 55% of our risk. Life risk are 18%, P&C risk 17%, and operational risk 11%. This is after diversification. Clearly, we have to continue to focus on our market risk. The fact that we have high market risk is not related to a fancy asset allocation. It's related to the fact that we have a very significant general account portfolio in our total balance sheet. So we need to continue to monitor our duration gap, continue to diversify our asset portfolio, and optimize the hedging of our assets and liabilities to reduce the tail risk. On new business, we need to shift the product mix to reduce going forward the exposure to market risk and further de-risk the portfolio, the products to adapt to the current environment where there is more volatility. I'd like now to move to the free cash flow generation. And this is the historical perspective of 2007, 2008, and 2009. You can see that if you look at the dark blue bar, we have generated each year close to 1 billion of free cash flow after paying the dividend. Obviously, we had to reduce the dividend in 2009 on 2008. As you will recall, we paid 1.3 billion of dividends at the beginning of this year. You see also in this slide that P&C and asset management have been strong cash flow generators, but that the life side is also generating, on average, around 1 billion of free cash flow. So in 2010, we expect our operating free cash flow to increase, and we believe that we are going to again have an excess over the what is required to pay the dividend that we've already paid. To achieve that, we have to focus on upstreaming of this operating free cash flow from the operating entities to the group. And you see here that we show our main operating entities, starting with the US. The reason why the US has not brought cash to the holding company is not that the insurance company in the US is not generating dividends. It's that we have substantial debt at the level of the holding company in the US to finance money and AllianceBernstein acquisitions. And the free cash flow is used to pay interest and repay the capital on this debt. France has always been a very strong contributor to the free cash flow of the group. The UK was not in the past and will start to be this year and next year, even independent of the transaction that we did with Resolution. Japan, which had never been a contributor to our dividends until this year, will pay its first dividends at the end of this year and will be going forward a substantial contributor to our free cash flow. Asia Pacific has always been a contributor to the dividend of the group, but when you look at the various pieces of Asia Pacific, Australia didn't have a high free cash flow, whereas Hong Kong had a very high free cash flow. So therefore, by owning 100% of the Asian assets, contrary to what people would think, it improves the free cash flow position coming from Asia. The Med region has always been a strong contributor. Germany, except in 2008, was a good contributor, as well as Belgium, except in 2009. And Switzerland has been a very good contributor and should remain so going forward. And finally, asset management is a strong contributor to our free cash flow. So we believe that when you look at the earnings produced by our operating entities, roughly 75% of these earnings can be upstreamed. And so we are in a strong cash flow situation at the group level. We continue to have questions on the capital structure of the group, and I'm making today another attempt at trying to clarify that, hopefully with more success. The point I want to make first is that AXA SA is not an insurance company, so we are structured as a group holding, owning, I would say, a large span of local holdings, and there is very little cross-shareholdings in the group. The two notable exceptions are historical. A substantial portion, more than around 60% of our ownership in AllianceBernstein is held within AXA Equitable, and Winterthur, which we bought at the end of 2006, still owns some of the assets that the insurance companies of Winterthur held historically in the Winterthur group. But otherwise, we have a very pure structure of the group holding company holding participations in each of the local holdings. From a debt standpoint, we have internal debt at the group level. The net internal debt at the AXA SA level is 3.2 billion. AXA lending 8.4 billion to its affiliates and having loans from its affiliates of 11.6 billion. And this is one of the ways we have managed capital fungibility within the group, this use of internal debt. And we believe that going forward, we will continue to have strong cash flow generators in the mature markets, which will allow us to feed the needs of high growth life entities in particular during their early period of development. We believe also that we are going to be able to continue to manage our gearing in an effective way. So when you look at the portfolio of businesses that we have in the group, and you put on a chart value creation on one side and free cash flow generation on the other side, we clearly have high growth life businesses which are consuming cash. For example, our developments in China and India are consuming cash. We believe that we are going to be able to move, I would say, to the upper right corner of this slide, our mature life and savings and P&C businesses. The focus on cash generation will be amplified on the life side for the mature countries, but we believe that we can comfortably indicate that the free cash flow generation post dividends will remain of the order of 1 billion. Funding further strengthening of the balance sheet is needed, and external growth as we continue to have opportunities going forward. As a conclusion, we are going to focus on accelerating the long-term value creation on the group. From a capital standpoint, we are focusing on generating adequate free cash flows, which will fund this accelerated growth. We are quite committed on that. We have a renewed focus on efficiency both in life and savings and in P&C, and which comprises three elements: productivity gains, enhanced technical expertise in P&C through underwriting and claims management, and on the life and savings, a renewed focus on the in-force, which Kip Condren will comment this afternoon. On the growth side, we believe that it was right in 2008, 9, and 10 to take account of the current market situation, to focus on value and profitability more than on growth. We believe that we are well equipped to accelerate our growth. The AXA Asia Pacific transaction would obviously be part of that, but we also believe that we are going to continue to leverage our multi-channel distribution strategy with an enhanced focus on direct, an enhanced focus on bank assurance, and a better leverage of our proprietary networks. Thank you very much for your attention. Mathieu, do we have time for questions?
I think we have time, yes, for a few questions before lunch. So I don't know if there are questions in the room. Blair, maybe.
Thanks very much. Blair Stewart from BofA Merrill. The comments on the combined ratio targets are very interesting. It's a significant improvement in the current year combined ratio. Your claim that we've been and are at the bottom of the cycle is also interesting. It's not necessarily what we're hearing from other companies. And if you look at the pricing conditions today, they wouldn't necessarily suggest that. So I'd be interested in some further colour on how you expect to achieve that underlying improvement. And the second question is on cash flow. Just to get an idea of the scale of some of the cash flows you're expecting, I think if you look at 2009 as an example, AXA France paid a huge contribution to the holding. The Swiss business was 164 million, AXA IM was 150 million, but everything else was below 100 million, and some of them considerably lower than 100 million. So they might get a tick in the box in terms of paying something, but it's not very much. Could you give some colour on that, please?
So on the current year combined ratio, you've seen that we've been able this year to increase prices across the portfolio by close to 3%. Arguably, we have lost exposures on commercial lines a little bit, but we've continued to gain exposures on personal lines. This drive towards a current year combined ratio of 100% in 2011 and less going forward will be largely fueled by our commitment to reduce our expense ratio by 4 points over the next 5 years. François Pierson will give you more colorful comments this afternoon, so I don't want to I would say, preempt his comments this afternoon. I think you will get more color on that, but we are quite committed. And even though we see that the competitive situation varies depending on geographies, we have been capable of putting in those price increases this year, and we believe that we are going to be able of putting in the price increases that we expect next year without hampering our competitive position in a way that would be detrimental to our franchise. On the cash flows, I think that it's one of the benefits of a diversified group that not all entities are paying in the same year. I told you that we're pleased to see that Japan would be a significant contributor going forward, which was not the case in the past. We've had, I would say, investment performance in Belgium and Germany, which have meant that they missed 1 year each. But going forward, we are quite confident in the picture that I've presented to you. I take the opportunity that I have the floor to add one point which I have not commented on earlier on the life side. This is on page 5 of my presentation. When I presented the new business growth and profitability initiatives, and especially the in-force profitability initiatives going forward, I didn't comment on the fact that in the same way as we focus on productivity improvement on P&C, we also focus on productivity improvement on the life side and target a 5-point reduction in our cost-to-income ratio by 2015, which represents roughly 750 million euros of productivity improvements there. So this productivity effort is across all of our businesses.
Nick Holmes at Nomura. A couple of questions on the life side, please. You're focusing on protection a great deal, and I wondered if you could tell us whether you're concerned about the number of competitors who are also focusing on protection, and whether you think you have particular competitive advantages in protection. The other question is looking at the future of traditional guarantee products versus unit-linked. This is obviously a key question in Europe. And my question is really, do you see traditional guarantee-carrying policies continuing to be more important, essentially, than unit-linked, which I think is the truth at the moment? Or do you see that position changing dramatically? And how do you position yourself in that context? Thank you.
On protection, Nick, I think we have a number of competitive advantages. First, it has traditionally been a strength of the group in the various markets where we have significant market share. Second, the fact that we are stronger than many others in terms of proprietary networks is there a very significant strength, because the proprietary networks are better at selling protection than the, I would say, third-party networks. So I think this should not be underestimated. If I could just give you an example, look at what we've done in France since the beginning of the year, where we have very significantly increased the sales on the protection side through the proprietary networks because we wanted to do it. And at a time where general account products are less attractive for the customers, it's easier to redirect proprietary sales forces than third-party sales forces towards selling protection. So I think there, first, I mean, historically, technically, and distribution-wise, we have a significant advantage. On the second question, traditional guarantees versus unit-linked, I think the point of the cycle at which we are is a point where there is a lot of risk aversion from the clients. They are not ready to move for unit-linked, but we think that the risk appetite is progressively going to come back. We have already started to see some movements in that direction. If I take there too the example of the French business, which has been one of the most sensitive to, I would say, the risk cycle, the proportion of unit-linked, which was around 50% in 2000 and around 35% in 2007, had declined to 12%, is now coming back at around 15% for the year, and in the last months was around 18%. So we see the appetite progressively coming back. And if you make the assumption that rates are not necessarily going to stay as low as they are now, but are not necessarily going to jump to the roof, we think that the attraction of unit-linked may come back progressively. Do you want to add something?
Yeah, on protection, I'd like to add 2 points. First, traditionally, we are more of a savings life company than a protection life company. And we don't have our natural market share in protection. It's a question of mindset, it's a question of culture, it's a question of bringing in the technical competency that is required. We have this mindset, this culture, these technical competencies in some of our businesses. Japan is a great example of that, and it's no mystery if we have more than 60% NBV margin in Japan, it's because we are very strong in protection there. So this is a question of renewed focus. Yes, you have markets where the competitive situation is such that it's not going to be easy. I mean, if I take the UK as an example, in the UK we launched protection through the IFA market in 2004, and we were effectively surprised by the high level of competition that adding an actor like AXA was creating, and this has moved the prices. But we remain, and this is a business that we've sold, but we remain with a very strong protection offering direct in the UK. We are going to expand the direct protection offering across other geographies. Again, we need to change our mindset. This is something that we had not done well before. On the unit-linked, it's not going to happen by, obviously, by a miracle. We are, Kip will tell you more this afternoon, but we have, in France, as an example, changed the compensation of our distributors to focus more on protection, on unit-linked, and we are giving better crediting rates to our customers that have a proportion of unit-linked in their contract and not just general account guaranteed products. So it will be a difficult act to follow, but it's a commitment that we take.
Thank you.
Andrew?
Good morning, all. I had two questions. One on the cash flow. How are you defining free cash flow? Is it derived from the embedded value reconciliation from one year to the other? And around that, when you talk about wanting to retain 1 billion euros of free capital or cash each year, does that signal a change in the dividend distribution policy? The second question was around your return on economic capital. On slides 19 and 20, you give us returns before diversification. Slide 21, you give the 28 billion of economic capital post-diversification, but you split it pre-diversification. Is it possible for us to track any of this if there's a swing between pre- and post-diversification?
Okay, so the free cash flow, as we measure it, is the cash that comes to the holding company. And we've started to give you at the half-year reconciliation for the life side with the EV, and we will continue to do so on asset management and P&C. It's very straightforward because it's basically the earnings. Dividend distribution policy, we didn't intend to change it. What we were signaling is that we believed that without changing our dividend distribution policy, which is 40 to 50% of our adjusted earnings, we would be capable of having a free cash flow after dividends of 1 billion, at least 1 billion. On the third question regarding pre- and post-diversification return on economic capital, I would suggest that you take that question offline with the IR team.
Last one.
Farouk.
Sorry, Mark Thiele from UBS. I have one question related to slide 21. Can you give us the split of capital in terms of what's in growth markets and what's in mature markets, and how you expect that to change going forward? And then secondly, the 1 billion free cash flow you expect to generate, shall we assume this all going to get invested in growth markets?
So in terms of the splits between growth and mature, I would say that you have a part you have a part of the answer in Henri's slide at the beginning of the presentation, where we show
with one reservation, which is that Japan is probably is in Asia.
Yes,
is in Asia Pacific.
But basically, less than 10% of our current capital is in emerging market, is in a high growth market. I would say probably roughly 10%. It's 90 mature and 10 emerging, roughly. In terms of the allocation of the 1 billion of free cash flow to high growth markets, I would say that most of it, yes. I cannot guarantee that we will do absolutely no deal in the developed markets.
I think you have to take a pragmatic view there. I mean, what we want to capture is growth, and you can have growth in major countries. Even if I look at Japan, which is one of the caricatural examples of a major country because the Japanese population is shrinking, we have been managing to grow some of the businesses because we are segmenting the offer and offering dread disease products to middle-aged Japanese women, as an example, even if it's a limited example, is a way to capture growth in a major market. And we would not refuse to invest in a major market where we could capture growth just because it's a major market. So most of it is probably going to go to emerging, but do not exclude, if we think we can capture growth in certain business lines within the major ones, that we would give up there. I mean, just take an example. I mean, in this market in France, if there is really an appropriate change in legislation as far as old age dependency is concerned, this could be a significant market. Why would we refuse to tap it just because Europe is seen as mature? Okay, we break up now, and we will after the lunch have the breakout sessions. Thank you.
I think we can start. So welcome to the Life and Saving Workshop. It will be led by Kip Condron, with the head of the Global Life and Saving business line, and Gérald Darlin, our Group CFO. So we'll have a presentation and then a Q&A session afterwards. Kip.
Thanks, Matthew. We want to take you through some of our key messages for today. The first three I'm going to handle, and Gérald will handle the last two. We're going to talk about our business strategy, the footprint that we have, and our focus with the global organization, the global initiatives we have in place to optimize our business profile, and our focus on the U.S. variable annuity business and the in-force book, which I'll talk about. Gérald will talk about our improved visibility of IFRS underlying earnings and our focus on new business IRR and operating free cash flow, some of which you already heard from Denis. We've got a very strong, resilient business strategy. We've got a strong footprint, and we've focused this global organization. And you can see that after the crisis in 2008, our life and savings business bounced back very quickly in 2009 and is strong again this year. Their underlying earnings on an after-tax basis year by year. This is a pretty interesting chart because it sort of divides the business into a bunch of metrics that show how balanced it is in a lot of different ways. First of all, on a product side, you can see that we're in the upper left-hand corner, we're very balanced from a product perspective, the general account protection and health being 29%, savings being 24%, mutual funds 12%, and unit link 34%. And then the new business value by product type, you can see has a fairly wide range. The unit linked average around 20%, the general account protection and health 38%, savings at 2%, and mutual funds at 5%. And then we've got a very sort of diversified geographical mix with 16% in the US. The 17% in the UK was before the resolution deal, so that will actually come down. 16% in Asia Pacific, 10% in the Mediterranean, Latin American region, 21% in France, and 20% in the North Sea. And then in terms of distribution, again, we're very diversified between our proprietary business, brokers, and bank assurance. So the business mixes up pretty nicely as we look at it from a global perspective. we put this global business together, as Henri mentioned this morning, about a year ago. And we put the global life and savings and the global property and casualty businesses together. And really, we set them up with a couple of key objectives that we were trying to accomplish. We want to get better speed to market. Particularly, we want to get our products to market universally rather than one geography at a time. Just a simple example of how frustrating that's been for us over the years. We initially came up with the GM XB products in the U.S. in 1996, and it was 2007 until we took them anywhere else. So it gives you a flavor for the opportunity here. We want to get an increased return on our capital, on our new business value margins and IRRs, and we want to leverage the resources of the group, and there are a whole lot of opportunities there, which we'll talk about. We've identified 4 key priorities. First of all, accelerating diversification into protection and health. You saw the new business value numbers for that. They're the strongest new business value opportunities, so we want to leverage those. We want to enhance the profitability of our savings business. You also saw the new business value there. It's very low. We think there are a lot of opportunities to capture that. We want to prioritize our investments in the growth opportunities and create more business efficiencies to fund some of those growth opportunities. We put a board together, the Life and Savings Board. Basically, it's the head of the life business in every single geography. Many of them are CEOs, and sitting up front, Fabian Ruprecht, who is my COO in the business, and we've built a central unit here in Paris, which Fabian runs, in order to sort of create the leverage across the board. So, we've got a bunch of initiatives in place to really optimize the profile and the model, and we want to remember why we're here. We're here because we want to focus on clients. We want to help retirees with guaranteed income. We want to help families accumulating wealth, and we want to protect families with health protection, long-term care, personal accident, and death benefits. So we see a bunch of opportunities. First of all, the protection market is huge worldwide. It's about $85 billion or euros of revenues worldwide, and we only have a 3% market share. So the opportunity for growth there is enormous. The emerging markets are a huge opportunity for us, and we list China, India, and Indonesia just as 3 examples, and you can see the growth numbers there. And then we have this huge in-force book of 26.5 million clients. We have 18.5 billion euros of in-force, and we have not ever sort of looked at it globally and said, how can we optimize that? And so we see that as a huge opportunity. So we've got 4 initiatives, as I mentioned before. We want to accelerate diversification to protection and health, enhance profitability and savings, prioritize our investments for growth, and then foster business efficiencies to fund all the growth opportunities. So let's start with accelerating diversification into protection and health. We've got, as we go through each of these, we have a bunch of experiences in each of these areas that we see as opportunities to leverage. For example, in direct protection in the UK, Sun Life Direct, which we kept, we didn't sell Sun Life Direct, has a new business value margin in excess of 100%, and it created 43 million euros of new business value last year. So the direct business is a highly profitable business, and we see an opportunity there. We'll come back to that. We want to leverage our existing distribution channels. We increased our individual protection revenues by 44% in France with the new family protection product, which is basically a family accident protection product. We've had great success there. The health and long-term care opportunities are huge. We have an opportunity to leverage what we're doing in France and Germany, where we've created great market growth and good new business value. And then the term and medical insurance opportunities in Japan are pretty substantial. And the thing that's neat about the way we do medical insurance in Japan is that the amount of payments that we make when someone makes a claim are finite. So that for example, we sell cancer insurance. So if you got cancer, we'd write you a check for 100,000 euros, and that's it. We have no further liability, and so we can actually underwrite it, and that's been one of the big issues in long-term care. As you see, some of the U.S. companies have taken big write-offs for long-term care. We always said we can't identify how to underwrite it, because you could potentially have an infinite amount of payments going forward. And I think that's what's happened to some of the companies. We've sort of stayed out of that, and where we've gotten in the long-term care business, we've really done it with finite payments so that we can manage it. Niche markets are another opportunity. Creditor insurance is a huge business. We've been very successful with that in a number of locations, and it's about 100 million euros of revenues. Today, we think we can take it to about 450 million over the next 3 or 4 years. So, what are we going to try to do here in accelerating our direct protection? What are our initiatives? First of all, we're focusing on markets with opportunities by putting in place one of the things we've always done. We've had a screening process for new products, but it's been a risk management process. It hasn't been a market-driven process. So we create a lot of products that pass our risk management criteria, but we're not looking at them to see how we can leverage them into other markets. We're not looking at them to say, does this product make sense? If we create some product that costs us 5 million euros to create, and we're only going to do 10 million euros worth of sales, it's kind of silly. And so we put this global screening process in place on new products that will create opportunities for us by itself. We're also building an international direct protection model. Remember, the Sun Life experience in the UK is very positive for us. So we've built a team headquartered here in Paris where we are building a global direct distribution business. We're starting with the pilot in Belgium in the first quarter, and we see an opportunity to leverage that. I personally think that one of the great opportunities there is in some of the emerging markets where we don't have any feet on the street, and you can go in with the direct protection model without needing to have an agent base or even have IFA distribution. You can go in with the direct protection model and create some new business value and some growth opportunities. We're driving the protection share in our agent and broker channels. We've got some simple offers out there. We're looking at more segmentation as we look at our client base. And we've been pretty innovative, particularly, as I said, in the long-term care area and in universal life, which we've created some new products in the U.S. And we're leveraging our employee benefit expertise. We're very strong in Belgium and Switzerland, and we think that we can move all of that into Poland and Spain in the next few months. So our second initiative is to enhance the profitability in the savings business. And a good example of that is what's going on in the U.S. in the variable annuity business. We restructured our variable annuity suite about a year ago. We introduced at year-end last year Retirement Cornerstone product. And Cornerstone is different from all of the other variable annuity products in the U.S. in that it's not a fixed rate roll-up product, but rather has a variable rate. And the variable rate is tied to 100 basis points over the 10-year with a floor of 4% and a ceiling of 8%. So the idea is that if interest rates rise, people's roll-up rate will rise along with it. So they have the option of buying a 5% roll-up on a fixed market basis pretty much today, or they could buy the opportunity if interest rates go up to have a hedge. We introduced the product year-end last year. In the third quarter, 50% of our annuity sales came from that product. It's very efficient. It uses a lot less capital. The hedging size of the hedges are smaller because of the annual reset on the interest rates, and it has stronger new business value. So it's a good example of how we can rebuild efficient products in the savings space. We also have done some work on structured products. We introduced a month ago, 5 weeks ago now, in the U.S., a product called Structured Capital Strategies. It's priced at about a 20% new business value margin. It's not dependent on interest rates, which is pretty attractive. And structured products are pretty neat in the insurance sector because there are a lot of structured products out there. They're getting a lot of traction. They're selling very strongly, but they're not wrapped in an insurance product, which in most places creates tax shelter or tax deferral. So the beauty of that is that the 5 or 7 years that someone's going to spend in the product, they'll defer the taxes until they take the money out, which has a lot of attraction. And depending upon whether there's also a guarantee, which there is in the U.S., by the insurance company, you have a double protection at the client level. So we think it's pretty attractive. It's been out there about 5 weeks. I think we've done $25 million worth of sales in 4 or 5 weeks. And like all these things, it takes a while to ramp up. We've had a lot of success in Monte Paschi in Italy with the product we call AXA Coupon. We've done 850 million euros in revenues, and it has a new business value margin of 15%. And so we're looking at structured products because, as you know, if you look at that, you can do a lot of different things with them. But we think that there's a huge opportunity to move assets away from our balance sheet, but keep them through the sale of structured products. And so we've got a couple of models, actually 5 models we're looking at for Europe that we think we probably offer 2 of them, and we think that that's a way of increasing the new business value in our savings business here. And then we've done a lot on the product design side. In France, we segmented the customer base by value, and we segmented the crediting rates. So basically, the higher value clients get a higher crediting rate, and the lower value clients get a lower crediting rate. Simple, but it was a huge lever for us. In Germany, we put in higher surrender charges, but we enhanced the terminal bonus so that at the end of the ownership of the product, the client gets a higher bonus and a lesser bonus on an annual basis. Again, creates longevity and more profitability for us. So our objectives in the savings business for continental Europe, we want to increase the share of unit-linked APE by 20 points between now and 2015. That would take us from about 23% to about 43% unit-linked. So the initiatives that we have, we're looking at optimizing the general account and the variable annuity products. We're repricing variable annuities and adjusting the crediting rates, as I mentioned. We're leveraging our sub-advisory models, which we have in the UK and the US. The unit-linked business is attractive for all the reasons that we know, but it's most attractive if you're doing it through sub-advised accounts. Because by doing it through sub-advised accounts, there are portfolios. We're the portfolio manager. We hire the sub-advisors. We get the margins that you normally would give up if you were selling someone else's packaged product. So we see a big opportunity, particularly in Europe, to create more sub-advised accounts in the models that we've created in the UK and the US. We also are looking at developing alternative unit-linked products. I mentioned what we're doing in the structured products area, and we're looking at guarantees which require less capital, like we've done in the retirement cornerstone product. So we do think that to drive the unit-linked business, you do need to provide some form of guarantee because people are so afraid of market volatility. But we also think you can do it in a way that's pretty efficient and easy to manage. And so we're looking to also use the advice model that we've created in the UK and leverage that in growing the unit-linked business, particularly in Western Europe as well. Third, we want to prioritize our investments for growth. The high growth markets are currently 10% of our APE. We've had a lot of success in our JVs with banks and with our own proprietary sales forces. You can just see the growth numbers in the Mediterranean, Latin American region, Hong Kong, Central and Eastern Europe, and Southeast Asia. Bank assurance, Denis mentioned some of these earlier, but we've been pretty successful in the bank assurance relationships we have. Monte Paschi's been a big win for us. Southeast Asia, we've got three strong relationships, and we built this business about a little better than a year ago, called AXA Global Distributors. The idea was to create a bank distribution business for variable annuities, and we're up with that. We're in six different products in a number of different banks in Spain, in France, and in the UK. So that's moving very well, and we've been pretty innovative, particularly in a lot of the products. We've done some neat things in Switzerland, gone into a number 1 market position through a combination of term life and variable annuities, lowering guaranteed rates and giving higher upside. In the US, our variable life product with the market stabilizer option, the problem with variable life in a volatile market or a down market is over the long term, clients are better off in variable life, and we're better off if clients are in variable life. But when markets are down, clients have a tendency and agents have a tendency not to want to sell it. So we put this market stabilizer option as a fund inside the variable product, which basically is a structured product, protects the client down 25% against the Standard & Poor, against a cap of 17 in a one-year period. So all of a sudden, we made that variable product feel a lot more fixed, and sales have begun to rise. And we also, as I mentioned, launched the Structured Capital Strategies product 5 weeks ago in the U.S. So there's some of the innovations that we've used. Our objectives, we want to continue to drive growth in the emerging markets. Our new joint venture with ICBC in Japan, or pardon me, in China is a huge opportunity for us, and we think that that's the way to really get true growth in the Chinese market. And then the international health business, particularly in Asia and in the Middle East, are huge opportunities, and we've got a very strong health business in the UK, AXA PPP, and we've begun leveraging that into Asia with a pretty strong success rate in emerging countries, and so we think that has a lot of opportunity for us. On the developed markets, we're just focused on higher margins. Creditor and bank assurance and structured products all are strong, profitable businesses that we want to leverage into those markets. We want to increase our share in the profitable client segments, particularly the mass affluent. We're very strong there. Our products fit very well, and we want to continue to focus there. And then the protection business, we continue the product screening process as we look to grow all of that. And then finally, the global product screening that I was just talking about has really begun to pay some dividends for us as we're identifying products that we can put on sort of common platforms, which is one big issue. In a company like ours, we have so many different systems. We can put them on common platforms and we can leverage them into more than one location. Previously, we would create a product in a location and we would introduce it, and we would never try to figure out, does that have applicability in 5 other countries or not? And those are the kinds of things we're looking at now, and they're working for us. On the business efficiency side, we want to reduce our cost-income ratio by 5 points. Denis mentioned this, which would be more than 500 million euros on a pre-tax productivity gain basis. And we want to increase our operating cash flow. We're really focused on 2 things: expense management across the board, particularly in our support functions. And then we've got a global in-force management initiative in place. We think we can generate about $100 million in 100 million euros in savings the next year, with the target of raising that as we go forward, just by simple efficiencies and cost management initiatives. We also think we can reduce the capital consumption, both by conversion and by reinsurance. We can improve our investment margins with crediting rates. We can improve our efficiency in claims management, and we think that we can re-engineer some of the claims management and drive costs out. And then obviously there's huge cross-sell and upsell opportunities. And then at the same time, while we're doing all of that, looking at the portfolio and determining where we don't think we can get the growth and where we have low strategic value, and either exit or run off or sell. And so, you know, we've been doing that selectively through the global portfolio, and we'll continue to do that. Okay, so let's take a look at the U.S. variable annuity book, which I know is of interest to most of you. First of all, let's talk about the reserving and the hedging program. First of all, we have a hedging program where we use derivatives to offset the movements in the fair value of the benefits that we grant to our policyholders, with the cost of the hedging covered by the guarantee charges. So we actually charge for each of those guarantees, and those charges we use to fund the hedging program. Now, IFRS reserving is the other piece of this that's interesting and important to know. The reserves for our hedged book reflect the fair value of the guarantees, and they differ from U.S. GAAP reserves, which is SOP 0301, in the U.S. filings, because basically what we're doing is we're taking our reserving, aligning it with the economics of the hedging program, and as changes in the IFRS reserves occur, they're offset by changes in the fair value of the hedging program. And any breakage between there goes right through our P&L. So basically our earnings are impacted by the difference between the change in the reserve assumptions and the hedging program results real time. For example, the basis risk that we had that was a killer for us in 2008, the difference between what we were hedging and what the actual results of the portfolio managers was actually went right through our P&L. And so our hedging program, I think, differs considerably from what you will see in a lot of the U.S. companies. And I think the thing you want to remember is that we're dealing with the change in reserves with our hedging program real time, taking any differences through our P&L. Okay, policyholder behavior and surrender risk. Second area of concern. First of all, we make dynamic surrender assumptions for both IFRS reserve determinations and in the hedging program. The assumptions differ by duration, because what you have certain periods in different types of annuities where your surrender charge runs out at a particular date. So our assumptions are that you have lesser lapses up until that surrender charge rolls off, and then you have what we call a shock lapse, and then you have behavior beyond that. So that's sort of how we look at it. And we recognize that policy holders who are in the money are probably less likely to surrender their policy during that time period. So our experience is that during 2009 and this year to date, surrenders have been lower on all variable annuities, not just CXB annuities, but all annuities. We have two books of annuities. We have basically the accumulator book of annuities, which has IB and DB guarantees, and then we have the Equivest book of annuities, which has no guarantees. And the surrenders are down comparably in both types of annuities. So, why are they driven? It's reduced benefits on new products in the marketplace. That's one possible reason. Higher in the money XB benefits is another possible reason. The third is that it's just an environment where people are not doing anything. And so whatever the reasons, in the second half of 2009 and in the second half, third quarter of this year, we updated our surrender assumptions for the long-term surrender experience. Last year we took a charge of about 30 million euros, and this year a charge of about 100 million euros. Annuitization risk, the other concern that everyone has about these products. And this one's kind of interesting because first of all, you have to wait 10 years before you have the ability to elect to annuitize. And then you can only annuitize on your anniversary date after that period. So you can't annuitize 364 days of the year. There's one day of the year that you can actually annuitize. And the election depends on probably your in the moneyness of the guarantee and interest rates at the time of annuitization. Our experience has been very, very good here. The election rate experience has been more favorable than our assumptions for reserves and hedging. There is a natural hedge here because most clients have both an income benefit guarantee and a death benefit guarantee. They can only collect on one. You can't die and live at the same time. So you're going to collect on the death benefit or you're going to collect on the living benefit. Point one. Point two, every year you wait to elect, next year's income will be higher. So if my income this year is going to be $10,000, next year it'll be $10,500. So if I don't need the money now, I can always wait a year and get more money. So you have a natural incentive to defer. So our assumptions are that if you're 0 to 20% in the money, we assumed a 5% election rate per year. If you're 20 to 50% in the money, we assumed a 10%. And over 50%, we assumed a 15%. Our actual experience is, and it's been consistent this year as well as in the past. It hasn't changed. If you're 0 to 20% in the money, we have less than a 1% election rate. 20 to 50, less than 2.5, and 50 to wherever, it's less than 5%. So our assumptions are there's a lot of room in our assumptions, and this book is maturing, so we're getting to the point where we think these are probably indicative of the way things are going to look in the future. And then we took a real crack at the in-force and in creating products for low interest rate environments. So what we've done in the post-08 environment is we reduced the benefits for accumulator. We took the roll-up rate from 6.5% down to 5%. We put a one-year wait in place for a dollar-for-dollar election. Most of our competitors allow you to do it immediately. We put a one-year wait in place for a reset. Most of our competitors are either daily or 1 year. Then we took on the in-force of accumulator, because of the basis risk experience we had in the fourth quarter of '08, we took $30 billion of accumulator assets and restructured them into index and enhanced index so that the hedging programs could match almost exactly. And so if 2008 were to happen exactly as it did again, we've eliminated more than 2/3 of what our costs were on the basis risk during that time period. We've reduced our guaranteed minimum crediting rates to the minimums where possible. We developed, the other thing that runs through our P&L is volatility, and we basically have priced the volatility at historically the 95th percentile of equity and interest rate volatility. But as we all know, the markets in the last couple of years have been a little more volatile than that. I think of the fourth quarter of '08, we priced the volatility at about 21% on equities, just for example. In October of '08, volatility was 80%, and in November it was 75%, and everything over 21 went through our P&L. So we said, okay, how are we going to manage that? So we came up with a concept where we created this product called the ATM, AXA Tactical Manager. And basically, it's a volatility management tool inside the portfolios that as volatility rises, we start creating cash using derivatives inside the portfolios. So that, and it's a win for both us, because less risk there for us. It's also a win for clients because their risk-adjusted returns are far better in that kind of environment than they were in the past. So that's been a big change that we've made. And we've, through new products, we've reduced the interest rate sensitivity and the size of the hedge through the Retirement Cornerstone product in particular. And of course, the Structured Capital Strategies product has no interest rate reliance. And then we did, if you go back to the pre-08 period, we had about 65 different portfolios that we were offering in the marketplace at any given point in time, and we let anybody pick any one or multiple of them. So theoretically, you could have some client who decided that they were going to take a small cap EFA fund and invest in it, and we couldn't hedge it. And so we eliminated about half of the portfolios that we had available, and then we limited the amount that we would allow people to invest in certain other portfolios, so that with this guided open architecture concept that we put in place says you can do one of two things. You can either have asset allocation portfolios, which are our sub-advised portfolios, and we hire the managers underneath them, and they're mostly indexed and enhanced index, or you can pick your own funds, but you're limited to 10% in this category, 15% in that category, and so forth. And we only offer things that we're comfortable that we can hedge well. Then we just took unprofitable products off the market. On the life side, the no lapse guarantee basically is a 30-year bet on interest rates, because you're basically guaranteeing the client that his product can't lapse based upon the current pricing, and we pulled those products at year-end '08, early '09. And then we eliminated the 30-year term product for the same reason, because we couldn't get comfortable with the 30-year risk on interest rates. And then basically what we've done in the US in the last 18 months, the analogy I'd give you is, if you think of us as a car manufacturer, we had what I would call some gas-guzzling big cars out on the road. We pulled them all in, redesigned them, and put hybrids back out there. So we basically redesigned the whole portfolio. On the annuity side, I mentioned Retirement Cornerstone, Structured Capital Strategies. On the life side, we built a new variable life product, the market stabilizer option I mentioned. And then in July, we introduced an indexed universal life product that if you look at it, the indexed UL product was introduced in July. In September, it was 17% of our sales. So it's really starting to ramp up. It's a very profitable product for us. Good for clients because again they can manage their situations better. So that's where we are on the variable annuity book. I'd like to introduce Gerald Harlan, and he'll take us through the IFRS underlying earnings by product. Gerald.
Thank you, Kip. Good afternoon. So you remember that in the for the presentation of the first half figures, we shared with you APE as well as NBV margins by product. So the objective today is to present it and to present directly the underlying earnings before tax for each category of products. So starting first with the book of business, and these figures are figures at the end of 2009, and you can notice that the average reserves amount to 470 billion euro, and roughly one-third, 31% correspond to unit-linked, 69% correspond to general account. And the general account can be split into two parts. The general account savings first for 182 billion, and second, the general account protection and health. So that means that as a whole, we can say, and that's what is mentioned at the bottom of the slide, 30% of our reserves are unit-linked savings, 40% are general account savings, 30% general account protection and health. All these figures that I mentioning here should be corrected, and that's what you have in the bubbles due to the UK transaction, but as a whole, the percentage wouldn't be significantly different. Moving to the next slide, here, you can, what is quite interesting is to see and to go along with what was explained by Kip, to go along to explain what where does the net inflows flow into. That means that you can notice first that out of these 470 billion of average reserves I just presented before, the net inflows for 2009 correspond to 8.6 billion. And you can notice that most of it is flows through unit-linked business, 4.4 billion, protection and health, 3.3 billion, and general account and savings is only 1 billion. So it's in line with the policies that we have been that has been presented by Kip, which consists in focusing on new business, mostly on general account protection and health, and also on unit-linked business. So here we go directly to the split of the pre-tax underlying earnings by product. And what we can say is that most of the pre-tax underlying earnings correspond to the protection and health business. It's 2 billion out of a total pre-tax of 3.2 billion. On a net basis, the total corresponds to 2.3 billion, which is in line with what had been presented last year. But it's quite, it's worthwhile mentioning that 63% of the underlying earning contribution correspond to protection and health. As far as general account and savings are concerned, it's 16%. But you remember maybe that this included where the one-off, it corresponded to the UK annuity portfolio one-off gain of 160.65 for general account and savings. And unit-linked is 339, corresponding to 20%. So almost two-thirds of our profit correspond to protection and health. Going into more detail, and you will, for those who want to go into more detail, please go to, you will go later on the appendix on slide 234, and you will see all the details of these margins between the three categories, the three business lines, i.e. product and health, general account savings, and unit-linked business. Let's start first with the general account protection and health. So what we can say is that, to make a long story short, the pre-tax underlying earnings of 2 billion and 31 million euros can be split, in fact, into two different components. The first component, just analyzing it, since we are dealing with protection business, just analyzing it just like a P&C business, because it's not very different. So using a combined ratio, this corresponds to a combined ratio of 94.1%. So 94, out of which the expense ratio corresponds to roughly 17%. So that's quite interesting to have to analyze this business just like a P&C business, because again, we believe that it's quite relevant. So 94% combined ratio. And the second component corresponds to the investment margin, and the investment margin corresponds to 52 basis points. So these two components correspond to the 2 billion pre-tax underlying earnings. Moving to the general account and savings, here we could say that on the first line you have the margin on premium corresponding to 2%, roughly. Investment and investment margin correspond to 64 basis points, and you can see on the extreme right that for the whole life business it's 68 basis points, so pretty in line. I remind you that in the first half of 2010 we were at 77 basis points, and at that time we said that we were pretty confident to stay within the 70-80 basis points range. Next, you have the technical margin. Technical margin is always, by definition, relatively small in terms of in our general account savings business, and it's out of these 222, as I mentioned before, 165 million correspond to the UK annuity business profits that we realized last year. Last remark, if you compare the 522 and you have all the elements to make this calculation with the appendix, the pre-tax underlying earnings of 522 euros divided by the average reserves correspond to 30 basis points roughly. So 30 basis points, again, that's not sufficient, and that's relatively low level of margin, and that's why we want to improve it. On unit-linked side, the top line, the margin on premium, it corresponds to 4% on average, so 556. Then the investment margin, it's the shareholders' margin, so it's the investment of the shareholders' margin. The management fees correspond to 123 basis points. You get this figure here on the right. And the technical margin, it's plus 147. What I can tell you about this technical margin, in fact, we have two components, and most of this technical margin is coming from the US. We had last year a negative contribution on technical margin coming from the GMXB at minus 133, but it was offset by 280 million of positive technical margin, mostly coming from the universal life business. Taking the same approach as for the general account savings, if you divide the pre-tax underlying earnings of 639 divided by the average premium, it's roughly 43 basis points. So what are the drivers of this profitability for these four different categories of products? First of all, net inflows have by nature a positive impact for all these business lines. Then we have a big difference between general account protection and health, where mortality, morbidity, surrenders flow through a technical margin, compared with the general account and savings, where the interest rates, i.e. the investment margin, is one of the most important one. For sure, as far as unit-linked is concerned, the relative level of the financial markets are a significant driver to the profitability of this business, and for the VA business, for the variable annuity business, we are dependent on interest rates and equity volatility. For mutual funds, it's net inflows and equity markets. So I propose you now to move to the new business internal rate of return, to give more figures, to highlight what was presented previously by Kip. And then we will go through the free cash flow generation for our life business. So first, the track record of the value creation. Here we are dealing with the life and savings EV. This morning, Denis presented the operating return on the group EV. Here we are focusing on the life and savings EV. And you can notice that it was pretty stable, but we had a decline in 2008. This decline in 2008 was mostly due to the decrease in NBV. So that's the NBV between 2007 and 2008, maybe you remember, declined by 43%. It was explained by volumes, minus 9%, and also by the margin due to the financial events. And the margin declined by 30%. Then we have another move, a positive move between 2008 and 2009, where we could say where the operating return on life and savings EV moves up from 9% to 13%. How is it explained? We can explain it by, I would say, mainly two factors. The first one is the NBV. You remember that on a comparable basis, our NBV improved by 5%. The second element is a higher implied discount rate. So you remember that in 2008, the market conditions were extremely poor, and that our EV was lowered, I could say artificially lowered, by two elements, which was the spread widening and the extremely low interest rates. So that explains the recovery in terms of operating return in 2009. Moving to the NBV, and the NBV margin has been highly commented. And what I would just on the first part, top part of the graph, the recovery between 2008 and 2009, I remind you that the move from 14.5% NBV margin to 18% NBV margin is due to two elements. First, the business mix, plus 2%, and the market condition, 2 percentage points. And it's although we had a lower APE, it was minus 11%. Nevertheless, we had the VA product, and we benefited from the VA product redesign in the US, and also higher protection in higher protection sales, which are the two elements that were mentioned before by Kip. Moving to what we call AA rating new business IRR. What does it correspond to? It corresponds to our internal rate of return, which is calculated based on a AA capital requirement, which is quite conservative. So we had a top in the range here that was in 2006 and 2007. So at that time, where we had an internal rate of return between 14 and 15%, we had higher volumes. Just to make it quite clear, if we compare from 2007 to 2009, the top line, the APE, declined by roughly 20%. So this has a negative impact on the unit costs. The second point is that at that time, i.e. in 2007, we had more unit-linked products. As an example, the internal rate of return of France was at 13%, whereas it was last year at 8% only. And the explanation is mostly due to the unit-linked exposure, and our sales in individual savings of unit-linked were at that time close to 25% compared with the 18% this year. So that's at the same time, we can say that in 2007 we had higher implied discount rate. So that means that the expectation for and you know that the implied discount rate is a significant component of our internal rate of return. That means that the expectation for rates for return on the different assets were slightly higher, which explains why we declined so much between from 14 to 10. So what, from now on, what I propose to do is to focus on the 10.3, so you can see in 09, just to go into more detail, explaining first where we are, how can we explain that we are at 10% only, and what's the action plan in order to improve this level. So, in starting first with France, I'm sorry it's a busy slide, but I believe it's more consistent if we can present it on a single slide. First, with France, on this slide you have the APE, you have the new business capital and strain, and this is a significant component of the internal rate of return. The lower, the higher the internal rate of return will be. And then we have the payback period, which is which depends on the IRR as well as on new business capital and strain. Starting with Swiss France. So as I said, the internal rate of return is 8% only. The internal rate of return for protection and health is 12%, much higher. And the internal rate of return of savings products in 09 were at 8%, including 15% of unit-linked. As mentioned this morning, since then, France moved up from 15 to 18%. As far as the US is concerned, so when we take the accumulator product and retirement cornerstones, they range from 10 to 20% IRR, but retirement cornerstones IRR is much more stable. It's less market dependent or past dependent. We have a low internal rate of return on term life products, which is roughly at below 10%, and it's due to the commission and to the strain, which is pretty high. As far as UK is concerned, the retained business after the disposal of the legacy business, the retained business internal rate of return is impacted by the scale and the immaturity of the product, but I remind you that what we kept is a capital light type of product. So normally, when we acquire scale, we should, going forward, improve our internal rate of return. As far as Japan is concerned, it's mainly protection, health, 12% IRR, and this 12% should be compared with the 10-year interest rate, which is only 1%. For North Sea, I would say I won't go into detail. It's a 9% internal rate of return, payback period around 11 years. Most of this business being general account business. In Germany, we benefit from the free RFB, which makes that roughly we have an IRR on the general account business of 10%. But of course, and I'll go there later on, we want to improve this profitability level. On MedLA, 10% IRR, 7 years of payback period, and I should mention that the MPS internal rate of return is 10%, because we have a higher the amount of commissions, of upfront commissions, is quite limited, which decrease the new business capital strain. For Hong Kong, Australia, don't need to comment, 26% IRR and 3 years payback period. So what do we want to do? Going forward, what we want to do is we want to increase our AA rating unlevered internal rate of return by at least 200 basis points as soon as possible. Of course, it will reduce the payback periods, and we will do it through increased exposure in unit-linked protection and health business, but we intend also to improve the more traditional business. Going through the actions taken for improvement, in France, we want to increase our unit-linked and protection business. In the US, as explained by Kip, You notice that he mentions that we will develop structured products, but also we have launched variable universal life products and other universal life products which have a quite higher internal rate of return, high margin. We intend also to optimize the value of in-force business, and that will be possible thanks to the productivity improvement as mentioned by Kip. You remember our objective to decrease our cost to income by 5 percentage points. As far as the UK, I made already a comment. On Japan, we are trying and starting to reduce the commission in order to spread the commission over time. You will understand that such a measure helps the internal rate of return. It's less capital intensive because that means that the initial capital strain is lower. So that's what we are doing in Japan, and we'll try to do it also in other countries. In North Sea region, we have repriced in Germany, in Belgium, we have reduced the guaranteed rates. We will focus also in Germany, for example, on single premium because regular premium are more capital intensive. And we will increase gradually the unit-linked share in Belgium. As far as Medeli is concerned, it's almost the same business, the same plan. Continue increasing our prices, lowering guarantees, and we want to improve our mix of unit-linked and protection products across the region. Moving to the free cash flow generation. You remember that we went through this slide on the 4th of August when we released the half-year earnings. Now you have more details, and what is interesting is to see what's the evolution. About the past, first I would like to remind you that as you can notice, the in-force surplus generation went down, and all these figures, you will be in a position to get all these figures also. You can find these figures in the EV reports in the past years. In-force surplus generation went down from 4 to 3.2 billion. This decline between 08 and 09 is due to the average unit-linked products, the average unit-linked AUM, which went down, and the capital gains at the same time were lower. You can notice that the in-force required capital changes was negative in 08, and you can be astonished because since we are dealing with the in-force required capital, normally it should be positive. It should be a positive contribution to the cash flows. Here it was negative because the 3.3 phase 2 regulation came in force, and in itself it explains 2/3 of this move. So let's focus now on 2010, and you can notice that even we give a guideline and an indication for 2010 as a whole, and you can see that we should move up from 08 to 1.2. It's an increase of 50%, which is great, and I could say that this increase of 0.4 billion can be explained by two elements. The first one corresponds to the UK. As I mentioned before, we sold our legacy business in the UK, and this has a positive impact of 0.2 billion. At the same time, we have improved the situation in different countries in the new business, but also in the in-force business, and it's an additional 0.4 billion. For example, it was mentioned by Kip before, retirement cornerstone has a lower business strain than the other type of products, and that's also why we introduced these products. Moving to the next slide. So that's the future free cash flow generation from in-force. So if you unwind, I would say, the embedded value cash flows at the implied discount rate, that's what we get. And you can notice that first remark, over the next 5 years, we are expecting 17 billion. 17 billion, that corresponds exactly to the 3.4 billion of in-force surplus generation for 09. But keep in mind that this is the unwind starting from 09. So on top of this, you will have the new business values that will be generated over the next years. So it's more than this. It's more than 3.4 billion that you will get, because on top you will have the new generation of new products. So that's the most important point. Second, we should add, on top of new business, there will be action to improve value of the existing book. I refer again to the productivity improvement. Keep in mind that the EV, the way it's calculated here, it's calculated without taking any kind of productivity improvement. So all the productivity improvements that we announced today will improve the situation. And at the same time, action to release more capital. We could go through reinsurance, being quite active on our portfolios. So just to keep roughly 15 minutes for questions, the conclusions. First, we will accelerate the diversification into protection and health. As mentioned by Kip, we will increase the share of protection and health business APE by 5% by 2015, roughly from 29 to 34% of our APE. Second, we will enhance the profitability in savings business, and our intention is to increase on continental Europe the investment and the share of unit-linked APE by 20 points by 2015, from roughly 23 to 43%. Prioritize investment in growth opportunities, foster business efficiency to fund growth opportunities, and that's the plan, the productivity plan, in order to reduce cost-to-income ratio by 5 points by 2015, which correspond to more than 500 million euros pre-tax productivity gains. Increase the operating free cash flows, that's what we discussed. Increase the AA rating unlevered IRR by at least 200 basis points in order, on a sustainable basis, and reduce the payback period. And we will put this all these action in place the soonest as possible. Thank you.
So we have about 10 minutes for questions. Yep. Just we have a microphone. Hold on one second.
Thank you. Oliver Steele from Deutsche Bank. 3 questions, if I may.
Okay.
The first is, are you able to give us some sort of indication of your protection market share by country or by major country, just to sort of see where you stand at the moment, and therefore what you're aiming for potentially? The second is, could you split the intended cost savings or efficiency improvements between acquisition costs and in-force costs? And then the third question is really about how quickly the profitability emerges on protection business. I mean, how much of that revenue margin comes through on the first year revenue, for instance, versus, the next few years?
Yeah. The protection market share by country, I don't know that we have that. If we do, we get it to you. I don't have it off the top of my head. Do we have that?
For Germany, yeah.
Thanks.
I have it here. For Germany, it's 6%, France 7%, Switzerland 16%, and Belgium 24%. Just to give you some examples. So it differs quite much by market. So these are the biggest markets, and then if you take the overall market share, can you imagine that there are other markets where there's quite a huge potential?
Then the acquisition versus in-force split on cost savings, we haven't broken it out. We're basically targeting each of the businesses and asking them to get productivity improvements. And we're looking for cost savings for sure, particularly on the in-force. We're also looking for productivity improvements, like, are you maximizing the crediting rate opportunity in your local business and so forth. So we haven't broken those out. And then what was the final one? I'm sorry, I can't read my own handwriting. I wrote it down.
Maybe a question was about the protection and health, and how does it how far in your appendix on page 5, yes, 5 of the appendix here, based on 09 for sure, you have an indication of what's the internal rate of return and what's the payback period. So that gives you an indication. But again, it's the way I could explain it is this integrates Japan, for example. As you know, Japan is a very long-tail business. So the long-tail business is slightly penalized because, as you know, the way we calculate internal rate of return doesn't favor the very long-term business. So we could say that the business that we want to develop in continental Europe in protection and health has a shorter maturity than this one. So it should be better. But this gives you an idea on average.
Next question. Somebody, yeah, go ahead.
It's Johnny Vo from Goldman Sachs. Just a couple of quick questions. Just in terms of your variable annuity book, what portion of your variable annuity book offers the dollar for dollar option?
Well, what portion is what on the dollar for dollar?
What offers that option, the dollar for dollar feature? And of those dollar for dollar features, how much have been utilised by policyholders? In terms of your IRRs as well, what are your assumed returns on equity and investment returns? And I suppose that goes for your cash flows as well. Thanks.
I'll let Gerald take the second part. On the first part, on the dollar for dollar, we, as everyone else, offers dollar for dollar on all the products. What we've done different from a lot of our competitors is we put waiting periods on it. So on the retirement cornerstone product, you have to wait 3 years to elect the dollar for dollar withdrawal. And you have to wait 1 year on the accumulator product. Most of our competitors allow an immediate dollar for dollar withdrawal. Our current election rates on dollar for dollar over the whole book are under 20%.
To answer your second question, you get the answer in the EV report of 09. So the implied, for the new business, the implied discount rate for 09 was at, on average, at 5.18%. Your question was about the equity return, and the equity return on average was just below 8%, 7.9%.
Question, okay.
Yeah, just on your VA annuity reserving, the net number, the 100 million for the second half of the year, would it be possible to gross that up, please, for DAC and tax, and give us the number of the actual reserve addition under IFRS, please? Sure. Secondly, if we have that number, could we break that down between how much you added in terms of changes in policyholder behavior, and how much did you have to add to reserves because of low interest rates? And then finally, just on the VA market in the US and the new products you're introducing, could you just comment on the demand, compare the demand you expect for your new products versus the old, and do you see your market share recovering back where it was, let's say 2 or 3 years ago? Thank you.
Let me take that first, and Gerald can maybe we can tackle the low interest rate issue versus policyholder behavior. In terms of the market, you've got an environment right now where, well, we built a retirement cornerstone product. It's got two pieces to it. One is the non-guaranteed sleeve, where you've got 97 mutual funds in a tax wrapper with no guarantee. Particularly attractive if tax rates go up in the U.S., which is anybody's bet at this point. But there are not many options for that many good investment alternatives inside a variable annuity. So that's relatively unique in the marketplace. It's not getting a lot of traction. It's getting about 20% of the assets that are going into retirement cornerstone. The guaranteed sleeve in retirement cornerstone is designed to hedge people against rising interest rates. Well, interest rates haven't exactly been rising except in the last 3 days. And so as a result, we think that our results in cornerstone are very strong. We're doing about 10 million a day in sales. And our market share in annuities is currently around a little under 5%. We at the peak, we were at about 8.5% market share in, say, the 07 time period. I personally believe that if you do get a move in rates and you do get a move in taxes, we're the only ones out there with products that are responding to that potential environment. Our philosophy, not to be a smartass about it, but our philosophy is sort of the Wayne Gretzky philosophy. We're trying to go where we think the puck's going, not where it is. And everyone else is sort of where it is at a fixed rate kind of roll-up rate product. Charles?
Yes. To answer your question, the one-off impact corresponding to the surrenders is roughly 350 million euro gross, and the net impact that we mentioned is 100 million. So you can, that's the reactivity, and the net impact is, in terms of reactivity, roughly in line with what you had in the first half, where in the first half you had something like 450 million gross of losses corresponding to the hedges, and the net impact was around 100 million as well. So just to give you ideas of what it means.
The other question was on that charge, how much of that was due to surrenders versus change in interest rates? That was all due to surrenders. Remember, we're hedging interest rates pretty much on a day-to-day basis, so there was no need to take any charge for interest rates. Take one more question. Yep.
My first question is related to the cost-income ratio target. What level of net inflows are you assuming? You're probably not assuming a flat cost base or flat revenues going into that. I'm just curious what top-line growth you would be assuming for that. Secondly, can you give us an update in terms of the hedging costs against the assumed hedging costs against the actual hedging costs, both for the current new business in terms of retirement cornerstone and how that compares with the book of business? And the third question is related to one of the comments in the slide. There seems to be a shift away from upfront commissions to level load payments. How do you expect distribution to react to that?
Okay. The cost income ratio, the growth assumptions behind it. I can't tell you the exact number. We ran a calculation where we're looking for about a 500 million euro improvement, and for us to manage it better than just to put the target amount out there, we wanted to tie it to the cost-income ratio. So we're working through what that means on a country-by-country basis, and we'll roll it up. So we don't have that number yet.
Yeah. Another way to explain it is to say that you notice that we said that it will represent at least 500 million. We hope that it will be higher than 500 million because we have been extremely, that's why we have a floor corresponding to a slow growth. But we are expecting to have a significant growth, and we are expecting as a consequence to have to achieve by 2015 more than 500 million.
So on the hedging costs versus what we anticipated, they're very dependent on market conditions, as you could well appreciate. We have done a lot of things to mitigate extreme hedging costs, like the volatility management tool inside the portfolios. We've gone to index and enhanced index to manage the basis risk, and so the one thing that has been troublesome this year has been the volatility of the volatility, if you will. And what happens is you get a spike up in volatility, and then a spike down, then a spike up, and trying to react to that in the amount of time intraday has been troublesome, mostly through the May-June time period. So our costs were a little higher than we anticipated during that time period. But I would say we're pretty much on track for what we anticipate the hedging costs to be. I mean, it's go ahead, Jim.
Yes, one about the retirement cornerstone. The interest of such a product, first, is that it's in both interest of the clients and of the shareholder. Why? Because the amount of hedging, of interest rate hedging that we are doing is much, much smaller. It's from 1 to 10. So that means that we have a commitment. We have a commitment which is not a long-term commitment. So that means that since, as you know, volatility is a significant part of the cost of hedging, it reduces, not to zero, but it significantly reduces the cost of hedging interest rates for these products.
Okay. I will take one last question. Time is up to give me a sign, Blair, but I'll take your question real quick. But as long as it's 1, not 5 or whatever, you know.
One question, 5 parts.
Don't you dare.
On slide 21, you give some details on your on policyholder behavioural risk. Is there anything you share with us in terms of the generation of the book and the percentage of policyholders in the money, the percentage in the moneyness?
Good question.
And sensitivities around that.
Yeah, good question. Actually, no. There's nothing that suggests that the behavior is materially different on the older the policy to date. So I think that we're pretty comfortable that the surrender activity and the surrender activity is driven more by shock lapses when the CWC or the surrender charge period rolls off. But in terms of the elections, we see nothing that would indicate that the length of ownership has anything to do with people's elections. Yeah, we're not seeing at the end of the 10-year. Well, they can't elect until the end of the 10-year, but 10 years versus 11 versus 12 versus 13, we're not seeing any material difference in the age of the policy as a correlation between that and the election. Thank you. I think our time is up. We appreciate it, and stay in here for the next session on property and casualty. There's some coffee in the back of the room if anyone wants to get up and share that.
Good afternoon, everybody. I hope that you are not too tired with this second workshop, and welcome to the PNC workshop. I am François Pierson. I am in charge of the PNC business line. I will introduce you the different speakers, and the first is Philippe Egger. Philippe Egger is in charge of AXA, is the CEO of AXA Switzerland, and Stéphane Guinet is the CEO of the direct operation. They will speak with me, and we are also on the table. François Buchini is the Deputy CEO of the business line, and. Why are Philippe and Stéphane, why they are here to present with me? Because Philippe has the best combined ratio in AXA. Congratulations. And Stéphane has the best expense improvement in the year. I'm not sure that they liked the way that I present them, but it's not a joke, it's true. So I will switch now in French, and je vais aller directement au sujet en présentant cette première slide. En fait, l'année dernière, j'étais déjà à cette table, enfin ici ou ailleurs. En tout cas, j'étais venu présenter le PNC d'AXA, donc il y a un an. Et qu'est-ce que je l'avais fait avec François Buchini, et qu'est-ce que nous avions dit? Nous avions parlé d'augmentation de prix, nous avions parlé de discipline dans les méthodes de segmentation des prix, les méthodes d'augmentation de prix, mais aussi dans les méthodes de souscription, et particulièrement dans les lignes commerciales. Et en fait, nous avons parlé de notre volonté d'améliorer notre ratio combiné. En termes de croissance, nous avions mis l'accent sur 3 choses qui sont: nous voulions toujours de la croissance sur les marchés matures, et nous voulions accélérer notre croissance grâce au direct et sur les marchés, grâce à notre présence sur les marchés à forte croissance. Alors qu'en est-il au bout de 9 mois, pour un certain nombre de chiffres qu'on peut donner, au bout de 6 mois pour d'autres? Eh bien, nous avons augmenté nos prix sur les 9 premiers mois de l'année d'environ 2,8%. Ça a été fait. Nous avons eu dans de nombreux pays en commercial line une activité de revisitation du portefeuille, c'est-à-dire nous avons eu des activités des opérations de pruning, de résiliation de ce qui nous semblait être des souscriptions qui ne rapportaient pas de bons résultats. Soit nous avons laissé partir des affaires parce que nous ne pouvions pas les augmenter, soit nous les avons résiliés délibérément. Ça se voit d'ailleurs à la fois dans notre ratio combiné, ça se voit aussi dans notre croissance. Au total, le ratio combiné a été amélioré d'1,3 point comptabilisé à moitié année. En termes de croissance, nous avons eu une très bonne croissance sur le retail, qui a été de 3,9%, qui a été certes annulée par les opérations de pruning que nous avons conduites, qui ont fait que notre chiffre d'affaires a baissé quasiment dans la même proportion sur les commercial lines, qui fait que la croissance d'AXA sur les 9 premiers mois de l'année a été flat. Nous avons par contre augmenté notre activité sur le direct, puisque nous avons une croissance sur les 9 premiers mois de l'année de 20% sur ce segment de notre portefeuille. Et nous avons aussi entamé un certain nombre d'acquisitions, de sélectives acquisitions sur les marchés à forte croissance. Cette croissance sur ces marchés, d'ailleurs, a été soutenue, parce que si on accepte le Mexique, là où nous avons conduit des opérations de pruning vigoureuses, eh bien nous avons sur ces nouveaux marchés, nous avons une croissance de 8%. Voilà, rapidement fait le bilan, le bilan de ce que nous avons dit versus de ce que nous avons fait. Maintenant, si on passe sur la slide suivante, cet après-midi, nous souhaitons vous parler de quoi? Nous souhaitons vous parler d'abord de notre nouvelle organisation, de loss ratio, d'expense ratio et de croissance. On me dirait que quand on parle de P&C, parler de loss ratio et d'expense ratio et de croissance, c'est pas très nouveau. Cela dit, nous souhaitons mettre un peu l'accent sur l'installation de cette nouvelle organisation. C'est pour nous quelque chose non seulement d'important, mais qui va être efficace pour conduire ces opérations de restauration de la profitabilité, de notre loss ratio. Et nous souhaitons aussi mettre l'accent sur notre opération de réduction, optimize our business model to improve profitability, qui, en d'autres termes, peut être qualifiée de décroissance des coûts, opération de baisse des dépenses. Voilà les deux points sur lesquels nous allons mettre un peu plus l'accent, la nouvelle organisation, la baisse des dépenses. Et je vais commencer tout de suite quand on va aborder la slide suivante. Si on regarde, vu d'en haut, l'activité d'AXA, le portefeuille d'AXA en P&C, vu d'en haut, c'est un portefeuille, c'est un chiffre d'affaires de 26 milliards. C'est un ratio combiné courant 2009 à 104,4. Et vous vous doutez que nous ne sommes pas heureux avec ce ratio combiné courant. Donc, la première commitment que nous adressons, c'est améliorer ce ratio combiné courant. Et l'améliorer par quel type d'opération? Mais vous voyez sur la partie gauche de l'écran, 80% de notre chiffre d'affaires vient des marchés matures. Ces marchés matures qui sont quasiment tous européens, à l'exception du Canada en P&C. Et c'est sur ces marchés matures que nous allons conduire ces opérations d'amélioration technique et ces opérations de baisse des expenses. Alors, amélioration technique, eh bien, Philippe Heger va vous détailler quel est notre plan d'action. On va parler évidemment d'augmentation de prix, mais on va parler aussi encore de sélection de clients. On va parler de segmentation de tarifs, d'introduction sur le marché, sur le portefeuille du particulier de franchises supplémentaires. Enfin, les recettes qui sont connues de la part des assureurs P&C, mais qui nécessitent du courage pour les installer la plupart du temps, et en plus qui nécessite aussi la confiance qu'on a chez AXA de la capacité de nos réseaux de distribution à garder leur clientèle. Donc sur la baisse de dépenses, vous verrez que nous avons élaboré un plan d'action ça nous a pris un certain nombre de temps pour l'élaborer. C'est Stéphane qui va le développer. Nous voudrons baisser nos dépenses sur les coûts de distribution, sur les fonctions support et sur les fonctions opérationnelles. Donc trois secteurs sur lesquels nous avons détaillé un certain nombre d'actions. Et en ce qui concerne les 17%, le direct plus gross market, c'est à partir de ces 17% de chiffre d'affaires que nous voulons conduire, que nous voulons d'abord augmenter notre footprint et que nous voulons conduire notre croissance supplémentaire. Alors si j'en viens maintenant à commenter cette slide qui d'un côté nous donne les objectifs que nous fixons sur la partie droite et aussi un rapide commentaire sur l'installation du PNC Board, donc de cette nouvelle gouvernance. Vous voyez dans le rond, sur la map monde, il y a 14 personnes. Ces 14 personnes sont les CEO des PNC, des entités les plus importantes d'AXA, et leur rôle. Le rôle de ces personnes dont j'ai l'honneur de conduire les efforts, eh bien c'est le ratio combiné courant, et à commencer par celui de 2011. Le rôle ça c'est le rôle collectif, mais aussi on peut détailler d'une façon plus forte le rôle de ce PNC Board. Ce PNC Board doit définir la stratégie, doit mettre en place et définir les actions qui vont conduire sur l'ensemble du portefeuille d'AXA à des améliorations de la rentabilité. Il sera responsable du déploiement du plan de baisse de dépenses, et aussi ce PNC Board doit s'assurer que dans chacun des pays d'AXA, nous avons les compétences nécessaires pour être un des assureurs les plus efficaces et un des meilleurs assureurs des pays dans lesquels nous sommes. Chaque membre de ce PNC Board a deux fonctions. D'abord, il représente son pays, puisque nous avons quasiment l'ensemble des pays autour de la table. Et ensuite, il représente une ligne de métier. Il est l'animateur d'une ligne de métier ou d'une ligne d'activité. Philippe Heger, comme vous le voyez au-dessus du drapeau suisse, est l'animateur de Business IT Convergence. Stéphane Guinet, lui, il n'a pas de drapeau, mais il est en charge donc de la conduite, du déploiement du plan de baisse des expenses. Je ne vais pas tous les décrire, mais vous voyez que c'est un Canadien, Jean-François Blais, qui est en charge de l'animation des efforts que nous allons faire sur le retail, tant en termes d'amélioration technique que de croissance. C'est un Français, Jean-Paul Rignot, et un Allemand, Markus Hoffmann, qui est en charge de l'animation des lignes commerciales. Alors, ça, c'est l'installation de la gouvernance. Ce sont des gens qui sont donc maintenant responsables de ce ratio combiné courant, collectivement. Sur la partie droite de l'écran, nous voyons les chiffres auxquels qu'ils ont définis, que nous avons définis d'AXA comme target. Alors, court terme, moyen terme. Court terme, 2011, ratio combiné courant à 100. Sur le cycle, d'ici 2015, être capable de piloter un ratio combiné entre 96 et 100. Augmentation des prix en 2011 de 3%. Pour la deuxième année consécutive, nous augmenterons nos prix sur nos portefeuilles, mais aussi, dans un certain nombre de cas, sur les affaires nouvelles. Un objectif de moyen terme qui est 2015, baisse de 4 points de l'expense ratio. Vous savez, on dit souvent qu'il y a 2 ou 3 catégories d'assureurs, j'en retiendrai 2. Les assureurs globaux, ceux qui sont plutôt mondiaux, qui sont plutôt chers en termes de gestion, et des assureurs locaux qui sont moins chers et donc plus agiles et plus flexibles. Ce que nous voulons, c'est de descendre, nous, quelques marches du podium des assureurs globaux, en tout cas en ce qui concerne les coûts, pour nous rapprocher le plus possible de la performance des assureurs locaux qui, pour en prendre qu'un exemple sur le marché français, tels que les mutuelles, ont un certain nombre ont un avantage tiré par le fait qu'ils ont des expense ratios inférieurs aux nôtres. La troisième objectif, 5e objectif que nous fixons, c'est la croissance. croissance qui, avec un accélérateur de croissance sur les marchés émergents à forte croissance et sur le direct, vous voyez que nous fixons une croissance en valeur absolue de 10% sur ce des marchés, et nous voulons que cette croissance contribue à hauteur de 50% à la croissance additionnelle du groupe. Voilà, rapidement, alors ces indicateurs, ces targets, vous les aviez déjà enregistrés ce matin dans la présentation d'Henri et de Denis. Je les ai répétés. Je vais passer la parole à Philippe Heger et à Stéphane qui vont vous dire, eux, comment on va faire.
Thank you, François. I will try to give you some examples and not to go too much in detail of actuarial work because it's not my life. So I would say I go on the other hand with examples. And what I will do is speaking about underwriting, claims and reinsurance. These are the levers we have to improve our business or to have a good business currently. This is what we are doing, and I think this is what I have to do. Yes, it works. First example is car insurance, as you see on the screen, and to give you the context of the car insurance within AXA Group, you see here we have 23 million of motor policies. That's a huge portfolio. And you see also that in the, I will try to work with this. No, I can't. So you see that we are number one in several countries with very high market share. You see between 20, 11, 23% market share. That's huge. And if you look at globally on it, then we have 10% market share in car insurance. So it's the most important P&C business within AXA Group. It's the largest business, but also a very profitable business. You can take out huge profit in car insurance. It's what for us important. We have a distribution mix where we have 50% tied agents and 15% direct operations, where we can influence the tariffs and the policies more than in the brokers market. That's an important message, to have this 50% tied agents, because you can push through. And what we did over last year, we pushed through tariff increases thanks to this distribution mix. It's quite important to understand the distribution mix. This is now what we did in this business, and you see the light blue flashes and you see the dark blue flashes. The light blue, you see the example of UK. You have 9.8% tariff increase we had in this business in UK. And this was last year up to 9 months to the September 2010. And what we will do and what we expect a little bit less, but you see that we have still in France, UK and other countries very high tariff increase foreseen for 2011. And as I can mention that we did it in the last year, so we are quite convinced that we are able to push it through also for next year. And in average, we try to increase the tariff by 3% in 2011. That's the one part of this slide, and I would say this is quite a good story because we have proven that we are able to do it. And on the right side, you see the motorway program we have globally, and this is more the technical part of our retail, or here in this case car insurance. What we do here is the technical improvement, what is the actual work. We combine that with the marketing data to have a clear segmentation and then to have the right clients with the right prices. You see that with the word elasticity. This is an important point, and we learn there. Stefan will elaborate on this later in his speech. We learn from direct business a lot on this part, because they are used to have different prices at different moments and with different clients. And we learn in the, I would say, more traditional business the same, and to roll out this overall in the countries. The tools we need We don't have the equal tools overall, but we need it if we want to have a global pricing structure. And the most important of this is the mindset, is people. We have to recognize the experts. We have to use the know-how we have within AXA Group. It's a huge know-how, but we have to collect it and then to roll out overall and to recognize these people. This will give us the combined ratio by more or less 100 points and 100%, sorry, and this is a great story. Just for the elasticity, I take always the same example. It's you have price seekers and you have safety thinkers, and you can have different prices for both of them, and they are willing to pay it. Going to the next slide is commercial lines. This was an example of motor insurance. Now I come to the commercial lines, and you see also here the context of commercial lines within AXA Group, where we have between 6% market share in Canada, and we have on the left side the 18, 22, 14%. So we have strong market share with rankings in the market between number 1 and number 3. That's a great footprint with leading positions in our relevant markets. And if you look on the downside, on the bottom of the slide, you see also what is our business mix. And this is quite important, that we have a well-balanced business mix between liability, property, motor, and others. And this is a good mix between long-tail and short-tail business. And I would say also that we are more represented in SME than in the large corporate business. And this is also important because the large corporate business is more volatile than the SMEs. Going to the next, this is the context, and then you see here on this slide, you see what we did. It's the same slide as we had in the retail business with the dark blue and the light blue flashes. And you see we pushed through in the light blue flashes this year the tariff increases, and we will do so in average also for next year with 3% in average. This is, I would say, a great success for last year, for this year. Here we have also the mix of business lines shown with the same logical view on the dark and light blue flashes, and you see that we have more increased on the weaker business lines than on the stronger business lines, what motor fleet is well known for its weak position in combined ratio. So on the right side on this slide, you see what we are doing in this commercial business. This was already said by François. We are doing pruning, re-underwriting. That's something in commercial lines you normally do, strict underwriting. And what if you increase the prices, you have also to have retention measures, otherwise you lose a lot of business, and we were quite successful not to lose too much of this business. On the bottom of the slide on the right side, you see the international solution. This is the growth part, where we try to push through international solutions for SME. I would say we are quite good position to do it because we have a footprint in all countries. We can leverage this know-how. We have the network. We have only to use it, and we do it now globally together with this team, with François' team. And if you look on the next is the segmented offer for. I would say the example from Germany is IT, and this is a good example. It's a very, I would say, profitable industry, the IT industry, and we push through the market and replicate for all markets these segmented offers overall. This is the growth part of the commercial line. Going now to claims. Going away from underwriting to claims, you have on the left side of the slides, you have the 4 levers we have, and one is, the first one is fraud. Fraud is a question of automated detection of fraud. We had 1.7%, we are now at 2.3%. This gives us substantial gains of 60 million euros in 2009 as new savings. And if you look, the next point is leakage reduction. Leakage is nothing else than closed file review. You improve then your processes because you learn from your mistakes, and in the year after you have improved processes on better ratios. So we have here saved 50 million euros. What we do as next step is open file review. This is more proactively than the closed file review. And what we have seen in all countries is the main driver is recovery management, where we learn a lot in the improvement of the process and do better recovery than afterwards with higher savings. Insurance procurement is the huge bulk of the savings. We have here the 120 million. Here the example is windscreen with our contractor Carglass, and it's a win-win situation between the client because there is a leaner process, an easier process for the client. We have the lower prices per pieces, and so we gain also money. So this is a good example for the cost saving and client satisfaction on insurance procurement. Industrialization and standardization and IT convergence, first of all, is standardization of processes and products, and then you can make an industrialization out of it. And I would say here the best example will be also Stefan's business, and he will elaborate a little bit on this because it's easier on a direct business than on the mature markets with the huge business they have. But we are working on it and learning a lot from the direct business also. On the right-hand side, you have the example of car insurance, and you have the motor claims here with 7.4 billion. The upper part, bodily injury, there it's most important is to have a good case management, to bring back people in the working process, and 50% of our bodily injury cases go through this process. This is the smaller part, surprisingly the smaller part of the payouts, and the material damages is the larger part, and you have here also two examples how we handle that. The one is motor engineering automation. We go through, I would say, automated expertise, tele expertise, and then we have the reduction of the expertise cost here by 25%. This is claims handling, cost handling savings, and on the other hand you have the total loss management, where we started to do auctions by eBay, Ricardo or others, and we have 20% higher prices through these auctions than we had before. These are the two examples from the car insurance, and now leaving the claims part, going to the reinsurance part. This slide is also split in two. I start with the left side, and the left side shows our normal reinsurance program we have. You see the pooling mechanism we have, and I would say the objective of this is to have better capacity. We don't need the complete capacity which each country, when we add all countries, would give. As a result, we can have a lower capacity. So this is one point. The other point is we have a common platform for the administration, so it's easier to administrate these treaties. This is a very important point. Then we have better prices because we have the better purchasing power as a group than as a single insurance company. And we have lower counterparty risk as we are a group, and we have deposits from the reinsurance companies. I would say this is a normal behavior of a large group to have these programs. And you see on the bottom side, you see the example of European storm, and you see the different retention levels on this part. And then you see on the upper part of the program, you see the financial market, and this is the part you have on the right side of the slide. On the right side of the slide, you have our cat bond placed 2 weeks ago in the market, and it's a cat bond with 275 million euros capacity. This was to be diversified from the reinsurance market. That was one of the first intention we had here. It gives us also a little bit more power in the pricing discussion with the reinsurance companies. Then it's a multi-year cover. It's a 3-year cover with extension possibility of 2 more years. And it's not based on a definition of an event. It's based on the market damage with perils. We have been one of the founding members of the perils index, so it's linked to the perils index, and it's completely collateralized. So it's, I would say, completely fitting in the program you have on the left side. We placed it 2 weeks ago, but it will be effective only on the 1st of January 2011 for 3 years. This is the program we put in place, and I think we are one of the first movers here, and it's a huge step forward. Now I give the floor to Stéphane Guinet, speaking about business model, about something like direct growth, more exciting than reinsurance. Stéphane, the floor is yours.
Well, thank you, Philippe. Good afternoon, everybody. So I'm Stéphane Guinet. I'm CEO of AXA Global Direct. And as François said, I'm also a member of the AXA Global P&C board, in particular in charge of business optimization. I will cover 3 topics on the agenda. The first one is on our business optimization plan, so the famous 4 points. I will get into much more details in a minute. Then I will cover 2 other topics, so 2 growth topics. One, where are we and what are our plans as far as high growth markets are concerned. And then I will tell you a bit more about direct insurance at AXA. So if I start with business optimization, we came to the conclusion earlier this year within the P&C board and more globally within the P&C community at AXA that we needed and we wanted to reduce dramatically our expense ratio. So this expense ratio is currently, as you can see on the right-hand side of the slide, at 32%. When we include what we call the claims ending costs, which represent around 4 points. So it's 28 plus 4, so it's 32%. And this is the 32% that we will decrease down to 28% by 2015. So now if we look at this expense ratio in more details, it's globally at 32%. The big bulk of it is a central part, so it's distribution, which represents roughly 60%, or nearly 5 billion out of the global 8.4 billion euro. Or more or less 19% of the 32%. And then we have 2 bulks. One is operation on the right-hand side, and the other one is what we call support functions, including IT. And they each represent more or less the same size, 1.5 billion each, 6%, more or less, slightly more than 6% of the global 32%. And this is the starting point. So what did we do? Well, we collectively, as a P&C community, worked out in very much detail during nearly 6 months this entire value chain, piece by piece, sub-part by sub-part, and we came to a plan. And this plan, which adds up to this 4%, and 4% is over 1 billion pre-tax, is therefore not an aspirational target. It's not an aspirational target. This is what the P&C community, well beyond the P&C board, is now fully committed to do and to deliver with detailed plans in each geographies and across each of the levers that I will elaborate upon in a few minutes. So if I come now to the main initiative, so how will we get, how does this split, this 4%, and how we will capture it? So this 4%, as you can see on the bottom of the slide, derives from the 3 bulk, the 3 parts of the value chain. 20% will come out of support function. So it represents roughly 1.2 absolute expense ratio points. So 20% of the 20% of the 32 points it's more or less 1.2. So 1.2 will come out of specific initiatives that I will describe in a minute on support function. Another 1.2 will come out of operations. So operations is also roughly slightly more than 6 points out of the 32. And we will reduce these 6 points by 1.2 absolute points. So this will be reduced down to 4.8. And then finally, on the big bulk, the 60% of the total expenses, it will be reduced by 10%, which globally represents 1.6 absolute expense ratio points. So the 4 points is 1.2 plus 1.2 plus 1.6. Okay? So how now will this go through the P&L? Because ultimately, I told you it's not an aspiration, it's a plan, but now how will this plan go through the P&L? Well, on support function, it's all about reducing complexity, delayering the organizations, and we have already a couple of business line programs at global level, plus a couple of tactical local plans that will help us deliver this 1.2 points of improvement. It's all about what we call at AXA zero-based management and lean techniques for the ones of you who are used to, let's say, cost-cutting techniques. So it's really reducing costs quite aggressively. And 1.2 on support functions is very, very aggressive. The governance is in place, the plans are in place, the targets and the details are in all countries' book. So now it's running. You will not see all the benefits soon. It will go through the next, coming years. But ultimately, by 2015, we are all committed under the chairmanship of François to deliver this to the group. Now, as far as IT specifically is concerned, we will simply do more what we were doing already, which is ensuring that we further reduce complexity on our legacy system, but also more aggressively move towards what we call shared IT platform or components for the core business capabilities. So we do it on claims. Right now, we are building a global claim platform for 3 first countries, but this is supposed to become a global AXA P&C platform in the future. And we have some other initiatives on underwriting, on portfolio management across the overall organization. So this is about convergence, more convergence, less complexity, but also this is about sourcing, because part of the IT cost is people, and more the development of our solution will not be done anymore in mature countries, but will be done where the costs are low, i.e. in India, i.e. in Mexico, i.e. elsewhere. If I now come to distribution, the plan is also rather simple and straightforward. On one side, we will aggressively develop AXA-branded direct offering, leveraging the web and the telephone, and to build a book of business over time, which will be non-commission based. Okay, so this is a way to indirectly reduce the share of business which is subject to commission. This will grow a book which is not subject to commission, and especially for commodity products such as motor or household. So this is what we call now at AXA P&C lean motor. On the intermediated business, we'll also leverage much more the web as a way to digitalize the interaction between our customers and us, or our customers and their agents. And the whole point is also to reduce commission cost. Most countries already have what we call the building block to do this: the products, the IT component, the platform. In mature markets, in offshore markets, to do it. So it's really again about commitment and execution. It's not about inventing something. We know how to do it. It's now just putting fuel in the engine. And what the news is that we will put the fuel in the engine very, very, very aggressively. And finally, on distribution cost, we intend to improve what we call the efficiency and effectiveness of our sales network. So we'll help also our agents to become even more efficient. So we have some specific programs on this. And to use the web as part of their day-to-day life, Plus, we will further improve what we call our sales support organization, because distribution is not only about commission, but a part of our distribution cost is also our people, our managers, our staff helping distribution. And finally, on distribution costs, not only will we reduce them quite dramatically, 1.6 absolute points, 10 percentage points, but by doing so, we believe at the P&C community that we will also build progressively some key strategic assets for the medium term. Now, if we go to the operation costs, this is probably the area of the group where AXA has the largest expertise and where a lot has already been done. So you would ask me what has to be done more? Nothing, except doing more and more and more and more systematic. So we have decided to do it. So all the best techniques, practices in terms of industrialization, automation, offshoring, digitalization, paperless, massification of flows, etc., consolidation of site. All of this is part of the plan, depending on the starting point of each country, but clearly this is all detailed now and ready for execution. I mean, as you can see on the right-hand side, and I will not detail it because time is running and you may want to have a couple of questions, but we have some true experience on this. We have a lot of projects which produced a lot of productivity gains. So really on operation, it's really more of the same and systematic approach across the P&C family globally. So if we want to summarize on this first part, we have a plan and we are serious about this plan. It's not an aspiration, it's a detailed plan to reduce our global expense ratio by 4 absolute points, which is over 1 billion pre-tax for the P&C. This is a plan and there is a collective buy-in, not only at the P&C board level, so with my 13 colleagues, but with all our top CEOs and teams. So the entire organization is aware of this plan, is working on this plan, and this plan is due to produce its fruits over the next 5 years. And the final point on this is that, as you may have seen and as you have understood, the entire value chain has been analyzed, has been worked out, and will be optimized. So now, if I move to growth, because it was about cost and a bit of cost optimization, not to say cost cutting, and now we'll move to growth. So growth, as François said before, we have 2 really key initiatives regarding growth. One is on what we call high growth markets, and the other one is on direct. So on high growth markets, as you can see on this slide, AXA, first of all, is already a leading player. We are not the number 1, we are the number 2. We are the number 2 global player in terms of coverage of what we call at AXA high growth markets, with very, very strong positions in some markets, like in Mexico, like in Turkey, like in Russia, where we are number 2 in a partnership, like in the Middle East countries. So we have a very large footprint also in Asia. So this is the first point. And globally at AXA level, it's already over 3 billion out of the total P&C revenue. If I move to the second slide, thank you. As you can see, this business has grown dramatically over the last 4 or 5 years, because if you see the growth from 2004, it's been a compound annual growth rate of 30%. The premium has been multiplied by nearly 4, both organically and through acquisition and selective acquisition. And the global current year combined ratio is also at acceptable level, even if, of course, this combined ratio is also being improved over time. And going forward, we have 4 strategic imperatives. The first one is to continue our bolt-on acquisition strategy. So we have plans on this. It's unlikely, having said this, that we will, as you know, overpay our targets. So this year, just a couple of acquisitions were made, one in Azerbaijan, one in Serbia, and also a business started in Algeria, but nothing as major as what happened last year. The second point is something that we are also doing, but that the P&C board has decided to increase, which is this systematic transfer of expertise from mature market to high growth market. And I'll give you an example that François mentioned rapidly before, which is about Mexico. I mean, in Mexico, the turnaround of this business has been made a lot with the help of our Spanish colleagues, both on underwriting, on claims, on several fronts, on IT, on processes. So this is something we want and we are accelerating. Azerbaijan, which was started recently, will de facto be a hub from Turkey, so will be an extension of our Turkish business, which is a leading business in Turkey. So this is something we want to accelerate at the P&C board level, and that we are accelerating. The third point, which is critical also, is to provide capacity to some markets in commercial lines. So on some very selected business line, we want to leverage a group capacity. So either to leverage AXA Corporate Solution or our reinsurance capabilities at group level to further develop some specific business line like property, like marine and cargo. And finally, we are launching what we call segmented offers. So this is on the SME market, which are offers dedicated to some specific professions or activities, and that are launched across multiple markets. If I now move to direct, so direct is a long story at AXA. Direct started in 1992, so nearly 20 years ago. So 1992 with Direct Assurance in France. If I try to give you the history of the build-up of Direct at AXA, AXA launched after the French business, the Spanish business in 1997, then the Japanese business as a startup in 1998. Then in 2005, we bought a Portuguese portfolio, Seguro Direto. Then in 2006, we launched a Polish startup in Poland. Then in 2007, three key news. One, the acquisition of Kyobo, the leading Korean direct player. Also the acquisition of Swiftcover, that some of you will know probably in the UK. And indirectly, through the Winterthur acquisition, we inherited Touring, which is a nice Belgium direct business. And finally, in late 2008, early 2009, we launched Quixa in Italy, which is a full web direct business. And as you can see, in 2011, we plan to launch our next venture in India sometime next year. So all in all, what is direct at AXA? As you can see on the bottom of the slide, it's over 4 million now direct policies. We are covering 9 European and Asian countries. We have leading position in most of the markets. Number 1 in Korea and France, number 2 in Spain, in Japan, in Belgium, and very promising venture in the UK, in Italy, in Poland. And as you can see, it already represents 15% of the total motor book of AXA Group as a whole. And it's growing fast. It's growing at a rate of growth which is over 10% per annum. So today it represents, as you can see, something around 1.7 billion. And what is new is that last year the group decided to move progressively towards a unified governance, of which I'm now responsible, that will include Asia starting 1st of next year, so Korea and Japan. We are building what we call a global organization, trying to leverage the best practices and the scale effect that we can have in various markets while protecting accountability, because these businesses are very entrepreneurial business. And of course, we try to optimize at global level for AGD, for AXA Global Direct, the gross return, let's say, optimization, both across geographies and across cycles. If we move to next page, so in terms of strategy, what do we do concretely? I mean, 4 points that you have to remember. The first one is that we aggressively transition the model to what we call a low-cost web-enabled model. So low cost is about cost, expense cost. We have a whole set of initiatives in terms of platforming, automation, digitalization, offshoring, and already our best entities run at expense ratio below 20%. Web enablement means doing more and more business through the internet. At AGD level, globally, it's already over 50%. So over 50% of the figures you saw on the previous slide is done predominantly through the web. And this is further, accelerating. Italy, for example, is a full web business. So 100% of Italy or the UK is web originated, not 99, 100%. So this is the first part. The second key element of the strategy is to develop what we call direct marketing expertise or world-class expertise. And just for one reason, it's to decrease acquisition costs, because this is a business which, as you know, is non-commissioned. It's a business where we support the acquisition cost upfront. So the more we optimize acquisition costs, the better we are, in terms of profitability. And just as an example, this year, acquisition costs will have reduced unit cost by 19%. So it's not, so we work a lot on this. Another point that some of you who come from the UK will understand easily, that we are developing what we call an ancillary strategy, which means that we are making our basic offering much more simple and less rich, and we are building up ads-on, which on which levels of margin are much more, much bigger than the core, let's say, motor liability and damage coverage. And this is being done and rolled out across all countries. The third point that my colleagues already mentioned is world-class pricing. Clearly, direct is a type of business where we can test and do a lot of things in terms of both what we call technical pricing, but also behavioral pricing. So really optimizing the price/elasticity, both on new business and on portfolio. And now these techniques are more and more managed at global level for AGD. So it's not anymore managed at local level, because this is very advanced skills and techniques that we develop globally. And finally, we are building, or we try to build what we call a high-performing and entrepreneurial organization, because most of these business, as you may have seen in the previous slide, are startups or were startups a few years ago. So this is very important that we have entrepreneurs running them and developing them. So as you can see now in terms of figures, in 2010, this business is more or less at the level of profitability of the global P&C in terms of current year, and our aspiration across the cycle is to run at between 96 and 98. This is a plan, and this is what we will deliver. Now, if we, I think I'm fine with this. So, François, it's your now.
Thank you, Stéphane. I'm sure that you don't need a long conclusion, and I am sure also that you don't want a long conclusion. I will take the last slide only to say that our new organization has been fully set up. First thing, today we wanted to share with you some targets for short-term target and middle-term target. Short-term target is in 2011 100% for AXA current year combined ratio. For also short-term target, an increase of plus 3% of prices. For long-term, middle-term target across the cycle, a combined ratio between 96 and 100. A decrease of our expensive of 4 points on our combined ratio, including expenses, and a solid growth coming from direct and emerging market or high growth market. Now I think we have time to take question and to answer question. So the floor is yours.
Could you give us the trend for the reserves release for the next years? This morning it was said that it was depending on the phase in the cycle, but it was said also we are at the low part of the cycle. So what will be this trend in percentage of the combined ratio?
Well, the reserve release that we had in 2009 was a bit exceptional, but to make it, to give you a very straightforward answer, I would say that the recurring level of reserve relief that we can have each year is roughly 3%. As you know, we have more than our competitors, quite a lot of long tail business. So this is what we can have on a recurring basis, 2-3% a year. We'd like also to say that our cover ratio, which is the ratio between our reserves and our premium, has kept being stable all over the years and is probably the highest in the industry. 100 and yes.
Could you give some more detail on the work you're doing on efficiency and the expense ratio work, where that takes you to in your benchmarking exercises against the peer group? And I guess the obvious question is why now, as opposed to over the last few years? Have you curtailed any of your other growth ambitions in your core markets, for example? Just two separate questions there.
Well, it's never too late. I think that we don't compare unfavorably to competition, but clearly we decided, and the P&C board and the global P&C community decided this year that we will address this issue seriously. And we came through a bottom-up exercise and not a kind of top-down target from the group to this amount of 4%. And on which, as you may have seen before, we have very, very detailed plans globally, locally, to deliver. So we will deliver these 4 points over the next 5 years. And this will clearly position us among the very best in the P&C world.
And we will start next year.
Thank you. 12 months ago, you told us that you were going to save 750 million euros over the next 3 years on claims handling expenses and claims leakage and that sort of thing. And you actually put up a slide showing the 2009 achievement, which is very similar to the slide you showed us this time. So I'm a bit surprised you didn't show us the 2010 achievements, given that that was quite a big target to set. So that's question one, is how are you doing in 2010 on last year's target? And then secondly, how much of last year's target is included in this year's 1 billion target?
So I didn't get the end of the question.
How much of last year's target is included in this year's target?
Oh.
Last year you set a target of 750 million. You're now setting a target of 1 billion. Are they
No.
No,
It
no,
is not
but
the same thing.
it's not the same thing at all. One is the productivity savings, and the other one is on the claims handling. And if you have the claims cost savings here of 750, that was a program separate of this 4 percentage point we have here.
Okay, maybe.
7% across between 3 and 5 years. You're looking for a 7% saving. Well, 750 million is 2.8% of your combined ratio. You're now saying you're going to save another 4% on costs.
Yeah, but one is on the cost side and the other one is on the claim side.
Is on the claim side.
But nonetheless, you're talking 7-point improvement on the combined ratio.
The 750 was over 5 years, 4 years. So that's roughly the 240 per year. So the 240 that you have for 2009 is exactly in line with the 750 that you saw last year. And it was, by the way, detailed last year with the 200.
You're on track for that.
Yes, what we did in 2008 was saying that we would achieve 750 million euros of savings in claims, which do not necessarily translate directly into combined ratio because there is also claim inflation and other topics. Still, if we come back to slide 11, you will notice that in 2009, which was the first year of the plan up to 2012, we have achieved roughly more than 200 million euros, which shows you that we are fully on track.
Okay.
Last? It's okay? No?
Yeah, just a quick follow-up on claims inflation. What is the assumption you're making in your budget on claims inflation?
1.2.
Yes. Between 1 and 1.5, which you have to multiply by 2/3 if you want to have the impact on combined ratio. But clearly there is a tendency to inflation on bodily injury claims, especially in UK. There is a tendency to decrease in frequency in motor in the midterm, generally in Europe. And in 2011, we have some specific issues with VAT increase in space and in Spain and UK regarding claims. We take this into account when we calculate price increases.
What do you think? Because I think you need a short break before the plenary session, but if you want to continue,
we have time for one more question if you want.
Thank you, Mathieu. No more questions? Yes, just, yes, two.
Hi, could you just help us with restructuring expenses in order to meet the 1 billion target?
Yeah, sorry. Can you just repeat a bit more loudly because I couldn't get it. Yeah.
Yeah, sure. Just looking for the restructuring expenses that you're likely to have to make in order to achieve the 1 billion improvement.
Yeah. Well, first of all, the 1 billion will flow across the next 5 years. So we are not saying that the 1 billion will come through next year, even if, as François said, it will start next year. And we don't give details so far in terms of potential restructuring cost.
This might be a little bit of a follow-up then. So can you confirm that there will, however, be restructuring costs, although you do not disclose them now? In other words, the 1 billion pre-tax profit improvement will be gross, but it will not be the net impact.
It's a net impact. It's clearly a net impact. It's a minimum of 1 billion, as you may have seen, pre-tax, but it's a net impact. And we are not saying that there would be significant restructuring costs. We are just saying that, we are saying something different. Huh?
Okay, so insignificant. And my question was actually, can you help us a little bit with identifying how the 1 billion might accrue in the various years until it is fully accrued in 1 billion? I can see the answer, maybe no.
Yeah, We do not intend today to disclose anymore. We can disclose, and we have disclosed with some details, the global 1 billion. Now we will not give guidance in terms of how this will go through the P&L around the next 5 years. As François said, it will start next year.
Okay, thank you.
Thank you very much.
If you are still awake, if not alive, a quick conclusion. After the workshops and after the presentation of this morning, in fact, I think the roadmap is a quite clear one. We are not going to change the fundamentals, but we have to redefine ourselves in some areas. The aspirations are, I think, quite clear. They are centered around a limited number of things where I think we've been pretty clear about what the objectives are. Redeploying capital with more agility, improving the profitability of the P&C and of the life operations with the targets we have set, running our operations more efficiently, improving the free cash flow generation, which was one of your questions, and there too we've given you clarity and numbers, increasing our exposure to high growth markets, and as you've seen, we are progressing on that, and the Australian deal should accelerate that. Accelerate the growth of the group, but not at any price, which means that the growth is going to be differentiated in developed countries, and that we are not going to target the emerging countries where you have no margins. Last but not least, continuing to invest and innovate, because we don't want to, I would say, minimize the efforts we have to make to stay competitive through innovation. So these things are quite clear. They translate into numbers. For those of you, I guess most of you, if not all of you, have attended the 2 workshops. On the life and savings side, it's increasing the AA unlevered internal rate of return by at least 200 basis points on a sustainable basis, so not a one-shot. We are doing it by increasing the share of health and protection in APEs by 5 points in 2015. Second point, we are going to increase the share of unit-linked products by 20 points by 2015. So it's a change in the mix working in favor of health and protection and unit-linked. We want to reduce the cost-income ratio by 5 points in 2015, which means more than 500 million euros pre-tax. We want to have a sustained investment margin of 70 to 80 basis points, and this will mean an operating free cash flow generation on the life side of at least 1.2 billion. So I think this is clear for the life and savings side. On the P&C side, in the same vein, the targeted current year combined ratio, will be between 96 and 100. We should reach 100 in 2011, next year. We are going to do that through a combination of pricing and efficiency. Average price increases of circa 3% in 2011, so comparable to what we have already achieved in the first 9 months of 2010. And we target a 4 points reduction in the expense ratio of the P&C operations in 2015, which means 1 billion pre-tax more when compared to where we are today. At the group level, the capital flexibility will be increased further. We think that we can target 300 to 500 million euros a year of realized capital gains going forward, and we expect to pump up 2.8 billion of dividends at the parent company level in 2010, which should put us in a very comfortable position to finance both the dividend and the capital redeployment. So at the end of the day, the model is a clear one. We want to continue to increase, of course, the employee engagement and the customer trust. And the way we are going to create value is by working on the three core elements of the engine: capital, efficiency, growth. We've made our case. We will communicate further on Ambition AXA during the first semester of 2011. And before that, of course, we are ready this afternoon to answer additional questions, both Denis and myself, and Kip, François, and the teams who have done the presentations during the workshops. So feel free to raise your hands and ask questions.
Thank you. I had a question on capital and fungibility, which you addressed in the morning. It's my feeling that companies are in an uncertain environment about their capital and fungibility because the whole balance sheet of insurers in Europe is going to be recalculated. We're not really sure how much capital they're going to have to hold in each subsidiary. It seems that when we start talking about assets, liabilities, capital, cash flow, we're actually in a very uncertain environment. How can you give us a confidence that you'll still be all right when we move into a Solvency II type of regime, or we'll deal with issues of equivalence, et cetera, et cetera?
Okay. Well, you can take the view that the world is going to its end, which one day will happen, or you can take a more balanced view. As far as Solvency II is concerned, I think there are reasons to think that the debate is going to be heated, but that at the end of the day, no nonsense, common sense will prevail. The framework has been very clearly defined by the European Parliament. And this is what should be the, quote, safety line. It's 99.5% probability of being safe with a one-year horizon point, which corresponds to the BBB capital level of a company. So, which means that if the implementation, if the level 2 measures are properly calibrated, the European insurance sector as a whole has excess capital. And this excess capital is sufficient to, I would say, deal with the current environment. What is the risk? The risk is over-calibration and uncertainty in the intermediary period. What we think, what we hope, is that the debate between the KEOPS, the European Commission, and the industry will be such that we will avoid, if not all, at least most of that.
But we are one of the strongly capitalized groups in Europe. We are a AA rated company. So when a tsunami hits, you need to be high enough on the hills, and we believe that we are high enough on the hills.
My question was less about your overall capitalization. I think you can probably convince us about that. It's more about where the money's held and the fungibility. I mean, it feels less clear to me than you've described it.
Okay, so we are discussing this question of dividend capacity with each of our operating subsidiaries on a quarterly basis, and more if needed. So the projections that we are giving you are based on the level of confidence that we've achieved with each of our operating companies, which are staying in close contact with their supervisors.
Nick Holmes at Nomura. A couple of questions, please. Firstly, on the P&C side, you've got a very impressively ambitious cost reduction productivity target. My question is, what would you say are the main reasons why you haven't been able to reduce expenses in the past, and what are the key differences, would you say, going forward from today? And then second question is, looking at Asia, assuming you're successful with AAPH, where do you go from there? And in particular, what will be the balance of acquisition versus organic growth? Thank you.
Okay, do you want to?
So on expenses, I think the main difference is François Pierson. To be no, I think the fact that we have created this global business line creates a lot more alignment within the group, because we are probably going to foster more convergence of operating models. Therefore, we try to make investments in a more rational fashion, and therefore we will get a lot more leverage from, I would say, more standardized platforms. That's probably point number one. Point number two is that we are going to benefit from new technologies. I mean, technology is evolving quite rapidly, and we are moving to, I would say, old technologies to newer technologies that will give us more efficiency in the way we interact with our customers and with our distributors. And I would say that also we believe that we are at a point in the cycle where we should have probably a slightly better pattern in terms of revenue growth that would help us achieve this goal in terms of ratio. So it's not going to be sheer cost cutting, hopefully, or not solely cost cutting, but also going to be capability to maintain our cost base flat as our revenues are growing. So those are, I would say, the three elements. But François, if you have other points to make.
I think also. So first, we have to start one day to decrease the expenses, and the time is coming. But I think more important, it's a question also of the age pyramidal, because we will have a lot of people who will retire during the period before 2015. And it's a very important levers for our plan, and also we need to decrease, because it's a voluntary action. We want there is two things of insurance in the world, global and local. And global are expensive. We are on the global insurer, and local insurer, like Mutual in France, they are very agile and not expensive. We want to join the local insurer, and we will try to do. It's a voluntary effort. It will start at the beginning of 2011. And we will have a period to decrease that. There is a lot of action, and we share all this action with different countries like AXA.
Thank you, François. On your question related to where do we go next once we will have completed the deal in Asia, as we have tried to describe you, we have a range of things we can do. There is organic growth in the existing businesses in the emerging countries, which should be high because these markets are growing, and we expect to gain market share. You should expect to see us doing more of these partnerships with strong local distributors. And then possibly you have the acquisitions, but it's what I've said before. It's something where you have to be pragmatic, and you should not have all your plans relying on acquisitions, because you have very few possible targets. And the other message is probably also, emerging is not limited to Asia. I mean, the same way that financial services are not limited to banks, emerging is not limited to Asia. You have other regions of the world where you can see significant growth. I mean, the Mediterranean region, South America, and there, I mean, we have a number of projects going on. I mean, you've probably seen in the papers that we have got the agreement to start to operate again in Algeria, which is a large market in Northern Africa. There are other similar things which progressively will increase the exposure.
Thank you.
Blair.
Thank you very much. Just one question, really. We've seen with companies that trade below their embedded value, that the argument on free cash flow clarity can be a very potent one, perhaps more potent than growth. And in that respect, you've given good guidance, I think, over a 5-year period on the P&C business, but actually very little on the life business in terms of your cash flow numbers. So maybe just give us your thoughts on where the cash flow in life is going over that period. And as a follow-on to that, you talked about upstreaming cash flow, again, only 2010 number. Does your inability to go beyond that reflect a lack of confidence in the conversations you're having with your subsidiaries? To your point, Denny.
I don't think I showed a lack of confidence in the quality of the dialogue with our subsidiaries. I think we've given some guidance on the life cash flows, talking about the 1.2 billion. It's right that we put that for 2010. So we've not given any further guidance beyond 2010, but we don't see any reason why the life cash flows beyond 2010 should be lower than that. We cannot give you a progression of this life cash flows over a longer period of time, but I think the 1.2 billion should be a good floor. But we don't have projections for 5 years at this stage, that's clear.
Yeah, Jean-Hervé Becourt, Chevreau. The first point you're highlighting as a conclusion is redeploy capital with more agility. You've been doing 2 big operations this year with UK Life, and hopefully, if you're successful, I wish you are on Australia and New Zealand. Is there any more to come, or are you satisfied with the structure of the group as it is? That's my first question. And on human capital, also, I think this is a big question. There has been a couple of moves this year within the top management of AXA. Are you satisfied as it is today, or is there more to come? Thank you.
On both subjects, I have a detailed list. No, I mean, more seriously, I understand the question, and you already know the answer. This organization is a living animal. I mean, it's not something which is crystallized, frozen, or whatever. We are never satisfied with our organization. We are never satisfied with what we are achieving, and we perpetually want to improve things and change things. I think the important message for you in terms of capital deployment is that there are no sacred cows. Many of you 2 or 3 years ago were doubting that we would ever sell an insurance business. We've sold insurance businesses. Many of you were doubting that we would sell insurance businesses in developed countries. We have sold significant insurance businesses in developed countries. This does not mean that everything is for sale either. And there are other ways to redeploy capital than just selling. I mean, there is one way, which is to allocate less without selling. And you have to be very granular to that. I mean, I would say to be efficient, you have to be granular, because in a given country, there are business lines which you want to develop and business lines which you want to reduce. And selling the country is not necessarily the best option. So we are going to, if anything, I would say, increase the degree of scrutiny we are applying to the operations. We have the very clear view that we need now to extract more from the developed countries to develop more aggressively in the emerging. It was less the case 5 or 6 years ago because the prospects in the developed were better and the prospects in the emerging were more limited. Now it's changing. It doesn't mean that the current model is wrong. Remember that 80% of the accumulated wealth is still in the developed, and the people who are underestimating that and underinvesting will lose their market shares pretty quickly. So I think we can combine both. On human capital, there too, I mean, it's a living organization. And if there is something where I think we have been very strongly reinforced over the last years, it's in terms of human capital, because we know better our own resources. I would say the level of transversality and depth of the organization and talent reviews we are doing every year has been better year after year. So the view we have on our talents is much better than what it used to be a few years ago. And we continue to attract very strong people coming from other companies all over the place. And we are losing very few people we want to keep. Once in a while, we are losing some people, not necessarily always the people we were willing, well, most of the time, not the people we were willing to keep. And having said that, I mean, you should expect to see, there is also an age, even in insurance, one day or the other, you have to retire. Even if we think that retirement has to come later than before. So you see people retiring here and there. It's not, I don't think it's a major issue, because we have a number of talents who are ready to take over in various operations. Other questions? Well, very few questions. Yeah, one. Nick.
Another question on P&C. I don't think you've mentioned what your outlook is for reserve releases, prior year reserve releases. I mean, the current year combined ratio target, 96-100. How does this affect reserve releases? Is it still 3%? I think 3% is the normal. Maybe 3.5% is the normal average. Is that still your target?
What we have said is that it's clear that in the very recent years we have released more because we were at the bottom of the cycle, because we had to release bonus coming from the previous years. The pace of the recent years is not necessarily the pace of the future. You should expect the same way, depending on the phase of the cycle, to see regular bonus coming out. Is the average long-term boni release going to be 2, 3, 3.5? I don't know, but we will continue to reserve conservatively.
Yeah, you should not lose sight of the fact that, as I've said this morning, we've restated our current year combined ratios since 2004. Therefore, the average of bonies should be restated as well by probably 1 point, 1 point and a half, something like that. You should speak to IR to check that. But therefore, the average level of boni and prior years should be smaller than what you had anticipated before, but the current year combined ratios should also be lower.
Yes.
Oliver Steele at Deutsche Bank. I'm sorry, this is a very geeky question, but I'm just looking at the free cash flow generation by country in the appendix. And on the basis that it's 2009, and therefore the numbers ought to be adding up to 800 million, you seem to be coming out with more than 800 million in the countries you've given us. And the one that's missing is Switzerland. So I was wondering if you could sort of fill in the gap, as it were. Is Switzerland negative?
Switzerland is part of North Sea, so Switzerland is included in those tables. So I think you should talk to IR after the meeting to get a detailed reconciliation if the numbers don't add up, but Switzerland is definitely North Sea. Blair.
Yeah, just on that slide actually, the question I wanted to ask, which relates back to my previous question, which I think was a fair question but didn't get a fair answer. The US life business generates more than half of the free surplus from the life of the group, and yet there's not been a dividend come back to London. Now, I understand the reasons you've given for that. So how much of it does get trapped paying debt interest costs, and your expectation is that that's still not going to pay a dividend back to London? Sorry, back to, I said London earlier, I meant Paris.
The reason why it would be trapped is because it would go to London, wrong address. But
I'm sorry.
But joke aside, the reason it's not upstream to Paris, for that matter, is that we have an amount of debt coming from the acquisition of Bernstein back in 2000, the buyout of the minorities back in 2000, and the acquisition of Money in 2004. This means that we have a significant amount of the holding company debt that sits in the US, and therefore it's going to take quite a number of years before we get to have fully reimbursed that debt with interest, and the remainder comes back to Paris.
No further question?
It's time, so.
Good. Thank you very much.